Mike Butler in Chicago with us to finish up this hour as we make our way through the most important event of the week, the Nvidia earnings due out in about 13 minutes time. If you're joining us on the website, if you're on the platform, come over to YouTube. Tell us what you're trading today, what you're doing ahead of these Nvidia earnings. If you're already on YouTube, join us on the platform on the website, tastylive.com. See what we're all about. Guys, it was a mixed day. Stocks tried bouncing earlier in the session. We had a little bit of a break out in the Asia and European hours. But then midday rolls around, the markets decide to keel over. We do bounce back a little bit as we go into the close. Ultimately, the S&P 500 up by 0.13%, the NASDAQ up 0.36%, your Dow Jones down by 0.47%, the Russell up by 0.28%. But just because there was some stability in stocks doesn't mean it was ultimately a good day. They are well off their highs. Cryptocurrencies continue to come off the board. Bitcoin down below 85K now. Haven't seen that in quite a few weeks. Other than that, gold, silver do bounce back. The dollar churning through a potential top still as yields continue to break down. 10-year yield closes the year at a fresh yearly low. But that all is just an appetizer, guys. Mike, you are the person among us who trades these earnings releases more than anything else. So let's just get to the meat of it and go to the charts and look at Nvidia. What are you thinking about today's market, the implied volatility that's priced in for today's move? What are you expecting here as we count down the clock?
I expect some craziness. I think it's interesting that the market has been so relatively bearish leading up to Nvidia, but yesterday we saw the big red day. It got gobbled up intraday, and then today we were up like 40, 50. I was like, okay, maybe Nvidia earnings, just blowing out earnings, skyrocketing, could be the catalyst to going back to all-time highs. But we've sold off from the recent highs, and we are in the I don't know range. I feel like the last hour of trading and tape action has really been like just absolute chop. Like we were down 20, we were up 20, we were down 20, and then we kind of closed flat. So I think the uncertainty is there. You had Salesforce come out a couple minutes ago. They gapped down from 307 to 275, and they've rallied to 295 since. So I don't know if that was a misclick by some big player or some knee-jerk reaction either way, but Salesforce, Nvidia, and Snowflake all coming today. Snowflake's up 20 points after the close. That's good for the data people out there. But yeah,
looks like Salesforce missed on revenue, and that was the on the forecast. So looks like they're expecting to be between 4.5 billion and 4.9 billion, and analysts were looking for 41.3 or 41.4 according to LSEG.
Lovely.
It's nice for Snow. CRM is not having a decent, not quite the same reaction that Snow is here. 294, Mike, you mentioned off from the levels closer to 307, 308 into the close. I think 307.47 was that close there. Guys, this is obviously a very important day here. Mike, I described Nvidia as the Atlas holding up these markets midday today. And even though markets come back in, it feels like that Nvidia really still fulfills that role here. Are we witnessing the potential turning point in this AI narrative from your point of view, or is this another day of earnings releases that we'll look forward to 3 months from now and won't really care about this random February 26th?
Well, Nick and I were calling it Nvidia Day today, so that's officially the name for it. But yeah, I think with such a strong concentration in products like SMH and the NASDAQ, if there's a big move in Nvidia in either direction, it can certainly kind of move the markets to a degree, and then that movement can create compounding movement from there. It's been interesting though to see like products like Apple ripping higher the last couple of days. It's down pretty big today, and you saw a reversal in some other products like Microsoft, Amazon, at least in the morning. So I think you're seeing a decent amount of rotation and churn in a lot of these products, but I think if Nvidia posts a big number or has some kind of headline that really moves it outside of the expected move, I think that could compound into other names, into other sectors as well.
You talk about that expected move. We look at the options chain, looking at $11.30 through, well, the end of this week. It's February 28th expiry here. So at 132, less than 10% right now on the board. Ilya, I saw a really fascinating chart here today from Warren Pies or Pies, if I'm mispronouncing that name. 314 Research is the amount of availability that for various GPUs that you could rent right now, and those that are currently, those that are on the market, as it were, the percent of minutes where GPU availability is out there for rental. And since the DeepSeek emergence back in January, apparently people are renting GPUs to run training, and they're scaling up. And so this oversupply that potentially we were talking about at the end of last year, are we overbuilding? We're starting to see more consumption come back into the space, which I suppose is ultimately a good sign if you believe in the AI revolution. This is perhaps confirmation bias for my own proclivities. But you think there's a bigger macro story at play here, right?
Yeah.
Like Nvidia earnings that are bad, if they miss, if they don't hit on the revenues and they don't give us the guidance that the market really needs, which is well beyond what the estimates are, of course.
Yeah.
Then this is occurring in the manner which the market's already dealing with a bit of a growth scare.
Yeah. So two quick things. Just on the renting of GPUs. I mean, obviously the perspective that sort of feeds the optimism in the narrative, as it were, is that, okay, people are coming out, they don't need to spend all of this money necessarily to build out, they can rent, and this will be a tailwind for the sector and the efficiency gains that they portend for the economy and all of these things. Or, and I don't think you necessarily know which one it is at this point, you could say, we have so many GPUs that people can now rent them because we have a situation where they're not being bought up by the people with the deep enough pockets to want to build out capacity. That this is already a sign of oversupply and overbuild. That there are excess GPUs that aren't being gobbled up by everybody scrambling to build their own, and now there is a supply that's available for rent. So we'll see. The larger narrative, I think, as you point out, is the macro narrative, because what Nvidia is at this point, I think, is to a large extent a known quantity in terms of sort of what normal looks like for them. They've been beating by smaller margins over the recent quarters. They managed actually to beat by a slightly larger one, announcement to announcement, for the third quarter, 8.3% beat on the surprise quotient for the EPS. But we're not talking about 29% beat, 18% beat, like what we were looking at in early 2023. So this is a different thing now. I think the markets are looking at this more as a kind of event risk way station. When you get to the other side and nothing shocking has occurred up or down, you come back to what the default is. And the default over the past several months really has been, we set a swing high on most of the indices in early December. We have not made any kind of serious attempt to take out those highs. We're stuck in a range, and more recently we're swinging into the bottom of that range because we got a second consecutive month now, as of Friday, of abysmal U.S. PMI data, in particular for the service sector, showing us that the service sector in the U.S. contracted for the first time in 25 months in February, which is incredibly ominous because the service sector in the U.S. has been the only engine of global growth for the better part of 2 years. I just had a long conversation on Macro Money yesterday about this idea that China is rebounding. People look at the rally in Hong Kong and say, oh, look, we have a rally. China is coming back. Well, no, the numbers are still awful. And when you look at the fund flows, it seems like the rally in Hong Kong is to some extent about DeepSeek, but more so about money fleeing China and people trying to evade capital controls. If there was, in fact, optimism that China is coming back, we'd see money flowing onto the mainland through Hong Kong. And we're not seeing that. So if you look at, for example, ASHR, the mainland index, it is anchored. If you look at FXI, it is surging, but FXI are all Hong Kong listed stocks. This is not mainland. So when you look at what's going on here, you're operating with no safety net. China is anemic. Europe is anemic. That's 2 out of 3 major engines of global growth. The only one that was working last year was the US, and the only reason it was working was the service sector, which is why even Canada, our closest trading partner, literally attached at our hip, could not make hay of US strength because we were not importing goods. So we weren't sending demand out into the world. We were being powered by a service sector mainly serviced by domestic firms. So this is the only real leg on which global growth has to stand on. And then we get the kind of PMI numbers that we got, which means that leg is giving way. How you don't get a global recession in this environment, if in fact what we're seeing in the PMIs holds, and I say if because, okay, 2 data points. 2 PMI numbers. Yes, the CPI numbers confirmed them. Yes, the ISM numbers confirmed them. Yes, the consumer confidence numbers, both from University of Michigan and yesterday the Conference Board, all of that confirms it. Let's get some hard data. Let's get a scary GDP number or something like this. But if in fact the U.S. service sector is giving way like these numbers suggest, I don't know how you don't get a global recession at some point this year. So not surprisingly, that's the story. And if Nvidia doesn't give people enough to basically forget that that's occurring, well, then that's the regular scheduled programming that we go back to.
Mike, we're obviously less than a minute away here. We can see that we're about, 30 seconds away, so hopefully those come out soon. If Ilya's right, then the bond market perhaps should stay on fire. Before we talk about Nvidia real quick, any strong feelings on which way bonds are pointing here?
I think it's been interesting to watch the probabilities of rate cuts going forward. I remember when I was talking to you and Mr. Radigan last week, we were looking at a 50-50 chance in June of a 25 basis point cut or staying where we are. Now we're looking at a 55% chance of a 25 basis point cut and even a 15% chance of a 50 basis point cut. And going to July, they're basically pricing in a 50% chance that we are at 40425 and even higher, almost double the probability at 30% that we go to 37540. So the movement in bonds, as I'm speaking, Nvidia had a big gap down. It's rallying from that number now. Looks like it's up.
I got the numbers here.
A couple points here.
89 cents on the EPS versus 84 cents expected. So that's a beat. Sales 39.3 billion versus 38.26 billion. That is also a beat. Their gross margins right in line at 73.5%. So Nvidia shares up here a little bit after hours now, 136. Maybe that little sucre that the market needed. We'll wait to see what we get on some of the guidance moving forward. So stocks up about 4% here after hours. Mike, this is obviously good news for a market that needs it right now. Nvidia is the big boy. Do you think that this could be the catalyst, depending upon what happens after the earnings call, that helps revitalize this beleaguered stock market over what's been didn't we just hit all-time highs last week in SPY and triple Qs?
Isn't this funny how the narrative shifts so quickly? You get a 5% sell-off or not even, and everyone thinks the world's crumbling. But yeah, good to see, if you're bullish, good to see the NASDAQ ripping higher. I think it's always interesting to check out some of the potential sympathy plays. So AMD moving a little bit higher. Of course, SMH and these other products that have a lot of Nvidia exposure are going to be moving higher too. But yeah, I think to answer your question, if we see a big rally in the markets tomorrow, a continuation with some of these tech stocks rallying, and a big vol crush, I think those three things kind of point to everything's fine. Let's continue on. But I
think if we,
like Ilya's saying, the numbers are not really telling that same story.
Yeah, I mean, to take a look here, I mean, on EPS, right, we were expecting 0.85, we got 0.89. That's a beat of under 5% relative to expectations. That's the smallest we've seen since the last time Nvidia underwhelmed, which was the third quarter of 2022. This is the smallest surprise quotient we have seen in the series of upside beats that we've seen for going on 2 years now. So is this news? I'm not sure.
Okay, so I have more on the numbers here. Their guidance for Q1, revs 43 billion versus an estimate of 42.3. They are expecting their adjusted gross margins to come in 71% plus or minus 0.5%, which is versus an estimate of 72.1. So that's not great. Data center revenues estimates, right, for Q4, 35.6 billion from an estimate of 34.1 billion. That's up 93% year over year. Their professional visualization revenue, I don't know why that's called out, 511 million from 486 million expected.
Is that the video game component?
The gaming revenue is 2.5 billion versus an estimate of 3.2 billion, down 11% year over year. Auto revenues are up about 103% year over year, but only a 570 million line item there. Jensen Wong in the comments says that demand for Blackwell is amazing as reasoning AI adds another scaling law. Increasing compute for trading makes models smarter, and increasing compute for long thinking makes the answers smarter. He also says AI is advancing at light speed as agentic AI and physical AI set the stage for the next wave of AI to revolutionize the largest industries. All that, and we get a lousy t-shirt because it's 1:32 here in Nvidia right now, basically where we closed. Maybe we were all right, Mr. Spivak.
I'm just going to go on record and say agentic is a stupid name. It should be just agent AI. I was having this debate with my wife the other day, and now I don't want to say debate because I don't think she was disagreeing, but she's a big marketer in the tech space, in particular in SaaS here in Silicon Valley, and she was saying that the word they've come up with is agentic AI. I'm like, this is terrible copy. Just call it agent AI. Why do we need to be so complicated?
Agentic
I'll get off my soapbox now.
Functioning like an agent. So, yeah, language.
I mean, agent AI just seems so much cleaner.
All words are made up. It doesn't really matter.
I digress.
They typed it into the Google machine and it said, acts like an agent. They said, yeah, that works. Let's run with it.
Yeah, that sounds right.
Like, okay, all right.
But yeah, some people in the chat pointing out volatility's getting crushed a little bit. I think you definitely saw some elevated IV in the VIX futures leading up into these big names announcing. So even with a Nvidia non-move, I think it makes a lot of sense that you are seeing volatility come out of the futures a little bit, just because if they're pricing in a potential surprise, which can always happen for any earnings announcement, even an inside move, if you were expecting a bullish move or bearish move, the fact that the market was pricing in an 11-point move and we are exactly where we closed at 3:00 Central, that can crush implied volatility too. It's not always related to a rally. It's more about how is this moving relative to implications. And even if Nvidia opens down a couple points tomorrow, you could still see a big vol crush throughout the day.
Right. That's why when you play some of these earnings releases, I know early on in my trading career, I would do rolls of the dice where it's like, oh, I'll buy an out of the money call around an earnings release or an out of the money put. And sure enough, the market moves close to that direction. And then all of a sudden, the position is losing money. It's like, wait, why IV crush. Right. I'm not making nearly as much money as I thought I would, or end up losing some. Vol futures are in here a little bit. During the day, they spike up in the VXH5 contract up to north of 18.70. We're down 1795. Mike, I guess my question for you is, Victor Jones often calls the 18 to 20 range kind of like the gray area, because you're statistically just as likely to go up another 2 or 3 points as you are to come back in another 2 or 3 points, to go from, say, 18 to 21 versus 18 back down to 15. So we're sitting at 18 on the nose right now. How do you approach an environment where vol is elevated but like not super high and has the ability to trend higher from here?
Yeah, it's a good question. I mean, I totally agree. I think when you think of the average implied volatility or VIX, it's around 15, 16. But so we're a little bit elevated from there. But when you look at the difference in the curve from each futures contract, we're still in contango. And as long as we're in contango, I kind of brush off these sell-offs. I will say a couple of days ago, we flattened out a lot. So when the VIX is at 19, you could see 19 across the board in volatility futures contracts. So the H, the J, the K, the M, all those were around 19. Now we're seeing a pretty sizable difference in price, with the H contract being at 17.95 and the M, for example, at 19. So when we're in contango and we're seeing moves that are expected, I think, it doesn't really give me any signals of a larger macro issue, even though I know Ilya is seeing them under the surface. But what I always say is like, okay, if you're looking for something that's really going to change the markets, you likely need to see velocity to the downside and sustained velocity to the downside, not this sell off and then buy it back the next day. And I think if you got that, like if you got 150 point moves 3 days in a row to the downside in the E-minis, you would see volatility in the 20s and you would see that curve flatten out or even go into backwardation. So for me, that's like the signal. If we go to backwardation, that's the signal for me to where we've already seen some velocity to the downside, but that might be a period of time where things are a little more murky and there's a lot more fear in the markets.
And I mean, looking at the S&P, you kind of see it, right? It's down, but it's down within the range that it's been holding for the better part of a few months here. So we're down, but we're not in panic mode.
Yeah.
We're not seeing any kind of a collapse. So the upshot continues to be, I think, if you're near the top of the range in the big indexes, then the risk reward favors a short. If you're near the bottom, then the risk reward favors being long. If you don't have exposure here, the risk reward favors doing nothing. You're not really in a position here where there's much to do. I mean, I guess at 28 IV, you could think about some sort of vol extraction with a condor type structure, but I don't really think the juice is worth the squeeze.
Stocks are up here a little bit off the swing low that we had going into the close, guys. 59.72. That's more or less where the market bounced back to. I think what we saw it squeeze up to 59.78 just as we saw the closing bell. This is an ugly day. I don't know. It feels like even with the Nvidia earnings, this action after hours, I look at the uptrends here over the past few months, Ilya, and while I've been lightly pressing on the long side this year through 2 trades so far, I see this failure up at that 1 week moving average. We couldn't climb over it today. I see us trying to scale the uptrend from the August and January swing lows, and we're not really making a bounce from there.
No.
Momentum's weakening. The NASDAQ is telling you the same story too. I mean, it's just not a market that ultimately is pushing for a significant bounce. Sure, it's an inside day, but like, where's the juice right now?
Yeah. Yesterday's NASDAQ action in particular, I think, is a little bit worrying because what you get is a nominally lower close through the preceding like inner range, if you will. Obviously, you're not approaching those levels below the 2100 level or 21,000 level rather, where you have that gray line, the kind of larger range bottom, but the inner range right around sort of the upper 21,000 area, 21.5, something like that. That range got those closes with the long wicks going back to early February. You managed to close under them Those, exactly. So if you look at where those closes are on that big red candle, the sort of post deep seek candle, that's a kind of line in the sand there, and we narrowly closed under it yesterday. It's a little bit tenuous, but that's more technical damage than ES has sustained. It's more technical damage than Russell has sustained. This is not great. And if you look at what we're looking at on the current candle, I mean, we just got these Nvidia results. Nobody was apparently sitting there with an itchy trigger finger going, oh, well, as long as these are okay, buy. Obviously not.
Nvidia still 129, 130. It looks like it's going to be that call that moves the market here because we're not really getting much of anything at all. Snow, CRM, those are still proven to be a little bit more active, at least. Snow here up at 181, closed at 166.20. We go over to CRM. This closed in at 307. It's currently trading at 291, so a little bit more direction. Guys, overall, when we talk about this market here today, and I say guys, ladies, and gentlemen, I assume not all men in the audience right now, the sector performance here isn't that great. I count 10 that are positive on the day. Semiconductors did lead up by 2.34%, but it looks like that's an Nvidia bounce back thanks to that Facebook or Meta data center announcement, $200 billion being invested for a new data center that was previously not known. Maybe we could look to XLP being the weak one here today, Ilya. Hey, Staples, which had been doing really, really well the past 2 or 3 weeks. This is a defensive sector, so it does come off the board. XLV healthcare is also weaker, down by 0.72%. So there's a modest retreat from defensive names. But I don't think this is anything to write home about. I mean, 15 of the 25, we're still in the red. And the sector rotation on balance for the past 5 trading days has been more late cycle equity rally than early stage equity rally.
Yeah. Yeah, I mean, if you take a look at what is going on here, I mean, this is not anything like people going, oh, shrug it off. This is not a problem. As we'd seen a lot of, we very much were in this mode before where, okay, there's been some bad news. Okay, there was a little baby sell-off, but there's growth, everybody. It's okay. So you lost some money today, but you'll make it back tomorrow because the economy is growing and people are getting hired and they're going to spend. And when they spend, then there'll be earnings. And when there's earnings, there's all kinds of good things happening. And so you can make whatever money you lost today back tomorrow, as long as the prospect of future money remains, then la-di-da, everything's okay. Buy the dip. And by the way, doesn't hurt that the Fed is out here saying, yeah, you know, we got to cut a little bit, but it's not for bad reasons. It's because inflation expectations have come in a lot. If we look at what happens to real interest rates when that occurs, then we don't want to let nominal rates out of whack, because if we don't move down nominal rates to line them up with inflation expectations, then real rates surge and we crush the economy. It's not what we want to do. We don't want to make real cost of borrowing net of inflation surge. That's going to ruin our soft landing. So we're just going to cut a little bit because inflation expectations have been coming in because we've been successful at beating inflation back. All good news. So cheaper money downwind, and there's growth. Let's all hold hands and sing Kumbaya. All great until the growth goes away. Because then debt to GDP ratios go up and financing starts becoming an issue after a big rate hike cycle with lots of debt rollover on deck this year and next. And people start to get skittish. They go, well, if there's no growth, then maybe there's a hit to earnings. Then maybe I don't get to make tomorrow money. Let me not part with today money or even put it at risk. And so you get this sort of general defensiveness when growth goes away. We talked on last call just a half hour ago about this idea that the market is developing a default, and that default seems to be pointing down in the recent days. And if you then get Nvidia earnings that don't change fundamentally what the landscape is, you just go back to default. We'll look at Nvidia now. We'll look at NASDAQ now. What are we seeing? Back to default.
Yeah, so the growth names today, even industrials, they up by 0.09%. But again, you look at that candle, we gap open higher, we try to trade higher, we end up moving lower over the course of the session. Mike, what's your take on what's happening in the crypto space right now? It feels like crypto winter may be starting to set in again. Even as stocks churn, the coins are getting killed.
Yeah, I think it's always worrisome when you see consecutive big red bars like this, but it hasn't been too different from the E-minis or NASDAQ, where we try to open higher, but we close lower. Bitcoin is the same story, but the last 2 days has been really interesting. It's the first time we've gotten below 85K since the initial post-election ripper. With that said, Bitcoin's implied volatility is significantly more than the NASDAQ and E-minis. So over the next 30 days, we're pricing in a range of plus or minus 10K. If you look at where we were trading a couple weeks ago, we were between 95 and 105. So really, if you think about that, back then we would have had a 10K range as well. We're just at the lower bound of that implied range. So I view rank in Bitcoin sitting at 9. Implied volatility is on the lower end of the range of where it's been, but it's still at 66%, which is a big number for a product in general. So yeah, I think if you've been looking for a time to get into Bitcoin, obviously this is the lowest price we've seen, but we're not really seeing too much of an implied volatility shakeup. And this could be just in line with everything else, where when you see bigger moves than you might think you would see in products like Microsoft, Amazon, Apple, Google, you should expect to see similar moves or more volatile moves in Bitcoin just because of the nature of the beast. But I don't really see anything shifting too dramatically under the hood here in Bitcoin, but you should expect to see these volatile moves because we get 20% weeks pretty regularly in Bitcoin, even though it doesn't feel like that.
It's been one of those weeks, right? A few days ago on the 21st, we were north of 100K, so now below 85. It's a 15% move in 4 days. That certainly shakes out some weaker hands. Guys, go over to Coin right now. Now, it's always odd when you get a mobile alert from your bank and it's like, hey, here's the text code for the account you're trying to sign into. It's like, well, I'm currently on air right now. I'm not trying to sign in anywhere. So gonna have to address that. Coin 212.96 up by 0.22. Some of these names that are kind of mirror images of the space, I mean, philosophically right now, it feels like the names that are associated as proxies, they're rallying up a little bit. But when Bitcoin's coming down, they're getting hit a lot harder than everything else. So, Mike, what's the case for like getting long deltas in Riot or Coinbase or anything, knowing that the rallies are shallower than what's happening in BTC?
Yeah, I like that idea. I mean, we've seen that before in the NASDAQ and other products where you see pretty broad-based sell-offs, and then you see a product like Nvidia that's not moving, which makes me believe if you see a reversal of that move, you would probably hang your hat on the product that didn't go down or didn't move in a favorable way for that to reverse. So MicroStrategy is another one. Someone in the YouTube chat pointed out that MicroStrategy is rallying into the close, which it did. But into today's move in Bitcoin, when we were down 4 or 5K, MicroStrategy was pretty flat. If you're looking for a roller coaster ride, MicroStrategy is probably where I'd go, especially because when you look at implied volatility in MicroStrategy, which has actually kicked up a little bit, IV rank of 33. You should expect to see IV around 100 in this product, but a couple of weeks ago it was in the 70s when we were just chopping around and not moving. So MicroStrategy, high leverage play. It's basically a volatility product of Bitcoin, if you want to think about it that way. Implied volatility explodes to the upside if you get continuous movement to the upside. Coinbase is another interesting one. And Coinbase, I think, is if you're agnostic to the coins themselves, but there's just if you think there's going to be more activity trading in Ethereum, Bitcoin, Solana, what have you, Coinbase, I think, is a more conservative way to approach that, since you're getting more volume flowing through there. But yeah, I would say Bitcoin futures, micro Bitcoin futures, IBIT is my preferred method. IBIT is my year-long trade for 2025. So I have a strangle on in there that I'm leaning up to the upside in. And I'm just going to have a strangle on in there all year. And it's a $50 product now, and it's basically tracks Bitcoin in lockstep, the percentage change in Bitcoin in lockstep. So if you're looking for a way to not have to work through crypto wallets and all those things, IBIT's an easy way to partake in that. And that has high implied volatility. And most importantly, it's a $50 stock, so you can really do whatever you want in there from an option strategy standpoint.
Ilya, it feels like this is a trade that's killing over quickly. If we were ticker agnostic, that looks like a heck of a top that's coming together, at least for the short term right now. It's not.
Yeah.
Go ahead.
We talked about the range break earlier this week, right? We were looking at BTC futures and essentially saying, well, look, if you know nothing, if you ignore what the ticker is, what did you see this week? You saw a range that's been holding since early November, let's say, and good night. That range is gone. So if you knew nothing about anything, you would just say, okay, technically speaking, if you're any kind of a chart watcher, any kind of a tape reader, one of these is not like the others. When you look at moves into 90,000 here over the past, 3, 4, 5 months. And that told you. And I've in the past been kind of skeptical of using technical analysis on Bitcoin, just because technical analysis, much like any kind of statistical anything, needs a good sample space, and so needs liquidity to work really well. Things get very choppy when you look at technicals on illiquid things. But I think with the advent of Bitcoin ETFs, this is safe analytical ground at this point. These things are like Bitcoin itself, I think, is liquid enough to where there's enough hands in the pot that you can expect that technicals should have fairly solid follow through. I mean, it's not the Euro or the S&P, but it should work reasonably well. Here we are. In my mind, technical analysis is most powerful when things are really obvious and everybody is looking at the same thing, because you don't really need for the technicals to have any empirical power, any intrinsic validity. Who cares? The bottom line is there's a range. That range has a line under it. If everybody is looking at the same line and you go under the line and everybody goes, oh, it's under the line, something is different, sell. Who cares if the line had any kind of validity, or you believe or don't believe in technical analysis? That's irrelevant. If everybody is looking at the same line and is going to sell under it, then it's going to work. And that's the level of maturation that it seems like we're looking at here, and Bitcoin is the weaker for it.
I would point out that if this is a measured move top, that gives you a destination perhaps close to 70K, depending upon where you draw your neckline. If you want to be a little bit more conservative and use the swing low from the third, it's going to give you somewhere closer to 74. And quite frankly, that seems reasonable, right around the highs that you have back here in March of 2024. I think that you make a good point. I mean, you can't really do fundamental analysis on cryptocurrencies, not traditional fundamental analysis anyway. You're going to use on-chain metrics, transaction counts, transaction values, active addresses, fees paid, hash rate, and staking. If it's a coin, it's a project metric like the tokenomics and initial distribution. And then maybe you could look at market cap, liquidity, and volume and some of the supply mechanisms. But like traditional fundamental analysis, there's no balance sheet for you to pick apart.
Right.
And so I've just found in my conversations with crypto people over the years, they've really leaned into TA more than anything else because it's a ticker on a chart, right? Like at least there's that universal set of principles. There are candlesticks. We can slap moving averages on them. Like we don't need to agree about what kind of on-chain metrics that we need to follow here. That actually means I think a technical topping pattern in crypto carries more weight than something than like a single stock name, because Apple could just throw in hey, big earnings release. Hey, a new product. Hey, they finally got AI to work on the iPhone 16. That could change the narrative in a heartbeat. Whereas Bitcoin doesn't necessarily have that going for it because there is no, cash flow, bringing in new nodes or increasing the speed of the Lightning Network. Like those are nice things for people who use it, but I don't know if they break the public zeitgeist for actually increasing demand within the product itself. Right. Either way, though, it's tough skiing right now. I mean, it's tough skiing for risk across the board, I think, is the important thing to note. We were talking about bonds briefly before Nvidia earnings came out, and this has been one of the few things that works if it's the ZN calls or for some people still in the short ZB put spreads. We now see a 10-year yield that's down to 4.251%, Ilya. Okay, should we be screaming with our hair on fire now? This is about 50 basis points lower in the span of a week and a half. Not quite there yet, but that's a lot in a short period of time. That typically does not happen.
No. And this is, I think, emblematic of the kind of move that you're seeing. I mean, for the record, I'm back long a TLT vertical as of yesterday. It's working so far. And I think this is part and parcel of this growth narrative that we've seen occurring. I mean, if you look at the front end of the curve and the back end of the curve, one of the unique things that we've seen happening recently is a more dovish view is coming into both. We'd been watching a 2-year yield that's done basically nothing going back to November. And of course it's done basically nothing because Fed policy expectations have been remarkably stable since November. The Fed had their big dovish jump in September, 100 basis points in 2025, 100 basis points in 2024. By the way, here's half of that 100 basis points up front. We're cutting everybody. It's all the things you've been calling for. And the market goes, yeah, that's too much. You've gone too far. And then when the Fed comes out in November, by then the markets have already shifted the yield curve to a much less dovish setting. Fed basically endorses that after the election in November. In December, they make it official with the new SCP. But by December, the Fed funds futures curve isn't really moving anymore. It's kind of wiggling back and forth a little, 20 basis points here, 20 basis points there at the tail end. But none of the big tectonic revision from September into November. And so then you look at the 2-year and you see from November onward until basically this week, it's not really going anywhere. All of the action is happening at the long end. And that's because anytime you get a piece of data that's good, bad, whatever, markets go, okay, one fewer cut in 2025, so one more in 2026. Or one fewer cut in 2026, so one more in 2025. And the aggregates don't move around. This week, in the wake of Friday's PMI shocker, all of them, the entire curve is moving to lower rates. We're going to have lower rates this year. We're going to have lower rates next year. This is a market that is actively baking in, seemingly, a Fed that has to respond to a growth scare. And that's different. That's a meaningful departure. That's not maintenance cuts anymore. And so, not surprisingly, bonds are going up across the board here.
I want to cover that topic that you just mentioned there. You brought up the word, and it's so crazy that you read my mind, because the spreadsheet that I have open here is on the very topic of the types
we've
of
only
cuts.
been doing this together for over a decade.
So I would point out, this is a spreadsheet that we looked at back in September when the Fed started its cutting cycle. And it was what happens under various cutting scenarios. Is the Fed cutting for a maintenance reason because inflation's come down and they can afford to take their foot off the brake? Is it for an emergency reason like COVID? Something's hit the fan, they got to respond, unforeseen. Or is it just because of your garden variety slowdown? The economy is going through a recession and they need to cut rates. So when we talk about it being a maintenance cut, this is actually a pretty good situation for stocks, right? The maintenance cuts here, you're looking at positive gains 3, 6, 12 months out. But when they're recession cuts, the 1 month, 3 month, 6 month, and 12-month return, they're all negative. And if we're just looking at non-maintenance cuts, because emergency is a little bit different, stuff hits the fan the first month after the maintenance cut, but then the Fed's here to save the day, so then the markets quickly rebound thereafter. But I would point out that if it's not a maintenance cut, or if it's for a recession, you're probably looking at a window where if those rate cut odds are being pulled forward once more, and yields are going down and stocks aren't going up, it's because the market's changing its interpretation of why the Fed has cut rates and why the Fed would be cutting rates moving forward. No longer is the Fed cutting rates because it's declaring victory. It's cutting rates because it thinks the economy is going towards recession. And that's a totally different ballgame for being long equities, as was the case last year. 23 and 24, the whole game was, as long as the golden goose remains, labor market's stable, inflation's coming back towards the target, growth is still positive, don't worry about anything. Kind of just shut up and buy stocks. But that's not the backdrop that we're seeing play out right now. And the narrative is shifting. So Nvidia, if you want to be a catalyst today, you've only added $1 here after hours so far, with about, we'll call it 34 minutes on the other side of the earnings release. Mike, is this shock you that the market was priced effectively right? I can't think of the last time we had an Nvidia earnings result where we were basically pinned as such.
Yeah, I hate this move because I told Nick on the show today, I was like, there's no chance it's going to open right at 1:32 in the morning. And now here we are. But when you bring up that chart and you put it the way that you put it so eloquently, if you think about the fact that the market always knows, like the market's going to move first and then the narratives come out, it does kind of make sense then that you have these frothy names that have had extreme moves to the upside, like Microsoft, Google, Amazon, your big tech stocks, Nvidia, and then you have your extra frothy product, Bitcoin, that was up, over 50% from pre-election to post-election, and now you're seeing a lot of that price come out. If these movements are kind of leading towards what you're speaking about, and we should expect to see some kind of neutral to downside move going forward this year, and people are getting ahead of it, it could be what you're seeing in the markets for sure. And the lack of ability of some of these products that everybody used to just gobble up, like Nvidia, the inability for Nvidia to have any kind of substantial or sustained move to the upside, I think kind of just adds to that.
It's like such a different cadence. It's like, oh, rates are going lower. Inflation's going to be defeated. Let's pile into the risk, right? The Fed's going to start cutting. Bitcoin goes up. This time around, it's not that way, right?
No.
Rates just closed on their lows. The market is telling you that credit conditions should be easier. Liquidity conditions should be more plentiful. And yet the risk assets are still being jettisoned. I would look at XRT, which is really interesting because, as we've noted numerous times, it's the ETF that tends to be most sensitive to growth conditions. And so when recession sets in, this tends to be the biggest loser. I suppose it's worth tapping on that again because XRT is down 1.19% today, a more substantial loser leading to the downside. Just like we would look to, a name like XLY, for example, consumer discretionary up by 0.38, and that's just really ugly down here. We can't pivot back through the January 13th low. Struggling now 3-4 days down here, guys. Whether or not we're looking at a late July type of setup in equity markets is a different story. there doesn't seem to be a carry trade component this time, Ilya. I don't see anyone chirping about BOJ rate hikes and that potentially destroying the market. Is there anything in the world of FX or international markets that we need to review here before we close the door on this Wednesday session and all tune in for our Nvidia earnings call with Jensen Huang?
Don't listen to the earnings call. Listen to Macro Money right after this show, where we're going to talk about the international component and the euro, because it's kind of a little series we're working out this week. On Monday on Macro Money, we talked about why the U.S. service sector numbers were so scary and why this is a recession scare. Yesterday, we were talking about, okay, well, if the U.S. is having a recession scare, who can backstop it? Is it China? That's the other big engine of global growth. And the answer is, well, don't look now, but the rally in Hong Kong is not the rally you think it is. It looks more like money running away from China, not money optimistic that China is coming back. Oh, and by the way, 7th consecutive quarter of deflation economy wide. No, China is not going to save the world economy. The third main engine is Europe and the Eurozone in particular. So if you take a look at the euro here, what you find is that you have basically these repeated knocks on resistance over and over and over again. Now, the ECB is supposed to be the most dovish central bank this year. They're on course for 80 plus basis points and cuts. So call it 3 with a chance of 4. So this should not be going up. Why is it going up? And why is it holding? Why is it not selling off? And that's really a story about they're not going to cut anymore because, interestingly, Eurozone inflation is actually going higher. And it's not going higher for good reasons. Yeah, okay, you can make all kinds of offsides here about energy is a bigger contribution, there's more uncertainty, maybe tariffs, this, that. The bigger issue is we're expecting Eurozone CPI to be 2.5% when it comes out next week. As of December, 50 basis points or half of a percentage point of Eurozone CPI was hospitality and recreation in an economy that's stopped, that hasn't grown in months, not with any kind of vigor anyway. PMI is basically flat at 50. So why is it that these discretionary areas of the economy, why aren't they feeling the pain and disinflating? Well, maybe it's because the inflation is stuck in labor markets. So the ECB does not have room to get any more dovish. But if the picture on the Fed is getting more dovish, then yield spreads move and the dollar starts to weaken in relative terms. So I think the story you're getting in FX here is there's maybe not meaningful changes except for the US, but that of course means the dollar gets shellacked against everything. And the euro is front and center, and all we're going to get is just more evidence that the U.S. really was the only engine of growth. We're not going to get any more tailwinds from anywhere else. We're not going to get a more dovish ECB. The China thing isn't working. And if the U.S. service sector now folds, again, I don't know how you don't have a global recession in that environment. And that then is what we're seeing across the board here. That's the response in Nvidia being as soggy as it is. That's the stock market being as soggy as it's been. That's the bonds being as buoyant as they are. You name it, that's what we're looking at.
Well, it's a good thing Nvidia didn't miss today. I saw one comment from Douglas Boneparth. If Nvidia misses earnings, the earth will explode. Mike, we really dodged the ball here. Saved. We have been saved.
We have been saved. That's for sure.
With that, overtime's out of time for this Wednesday, February 26th. We'll be back tomorrow, same time, same place, here right after last call, every Monday through Thursday, 4 p.m. Eastern, 3 Central. So for Ilya Spivak in San Francisco and Mike Butler in Chicago, I've been Chris Vecchio in New York. Good luck trading. Stick around, though. Tasty Live at Night continues next. Ilya Spivak's up first with Macro Money. I'll be here at 6 Eastern, 5 Central with Victor Jones for The Price of Truth. So stick around and then come back for more.
Know someone who needs a better broker? For 1 month only, earn $500 for each qualified person you refer to Tasty Trade. See how it pays to have friends? Terms and conditions apply. Tasty Trade.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
My name is Tom Preston, and I am the Chief Market Strategist here at Tasty Live. So every day I write the cherry bomb that goes out to our Tasty Live customers. And usually it talks about some potential trade idea that people might want to consider with a little bit of context about why a person might be interested in doing it. But the main reason that I push these things out is to get people to think in terms of volatility, liquidity, and probability in their financial decisions. What I want people to learn is an effective way to approach the financial markets and to use options to their fullest advantage.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
I got interested in trading when I was around 18 years old. There was a conference downtown and they just kind of described the very beginning of the market. It pretty much would say 99.9% of everything was stuff that wasn't covered in school, just how to leverage your investments, even with options, and that was just really attractive to me. I understand that no one can for sure predict if the market is going to go up or down, but with the research that Tasty does, we're able to find those optimal numbers to trade around to put ourselves in the best situations. One thing people can expect to see with my trades is just a very raw learning process, someone just really getting into the market, but really applying the correct principles and mechanics, a very non-emotional approach, just trading by the book, just to have an inside look on how it really is for someone getting into the market.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
The beauty of Thinkorswim was that we were different. From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new. The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. You know, that's what I do.
Well, it doesn't look like Nvidia cheered anybody up here with these results. Small surprises out on EPS and on revenue. In fact, the smallest since the third quarter of 2022. And the market seemingly going back to the previously scheduled programming set for us last week. We've been talking all week about the growing recession scare. This is Macro Money. I'm Elias Pivac, head of Global Macro here at tastylive. We got those scary-looking U.S. PMI numbers on Friday, suggesting that the last pillar of global growth is coming undone. And we've been going through it methodically this week. On Monday, we talked about why those numbers were so scary, what they meant, and why this is a global recession scare. We talked yesterday about why China, the world's second largest economy, is not in a position to be an offsetting force for that kind of a scare. And today, we're going to finish out with the third largest engine of global growth. And that, of course, is the Eurozone, and see if maybe we can get some help from the currency block here with the emerging growth situation, or if, in fact, we are looking at an environment where the giving out of the U.S. service sector and thereby the overall U.S. economy, the slowdown there, really does put us on a smooth and perhaps at this point irreversible glide path towards some sort of a global downturn. And we'll start the conversation with a look at the euro, because currency markets in their infinite liquidity and wisdom here are very telling indeed of what is going on. So we can see here the euro has been drifting a bit higher here since the beginning of the year. We put in that low just around the 102 figure as we started the year. And since then, the euro has been attempting to carve out something of a bottom. Now, obviously, the first thought is, well, something positive must be happening in the euro area for this to be happening. And so maybe capital is flowing to those markets. Maybe something is occurring to buoy investors' optimism. And indeed, when we look at the driving catalysts for the euro, we can see it is very much a creature of the short-term yield spread between benchmark Germany, the sort of stand-in for Eurozone borrowing costs, the largest economy in the region, and the US. And we're looking at the 2-year spread here because, of course, that is the proxy for the front end of the curve, the relative sort of measure of strength and weakness between what the ECB is going to do relative to the Fed. We can see here that as we were heading into the second half of last year, the dollar was strengthening against the euro. That's what you see right here. Euro going down against the dollar, and that was happening against the backdrop of the U.S. and Germany spread going down. So, in other words, the euro looked like it was losing a measure of yield advantage here. And when we consider this in context, it would make sense, of course, that if this is the relationship that holds, the euro would weaken. And we can see that going into the new year now, some stabilizing in this spread has occurred. And so likewise, the euro has found a bottom. So that kind of rhymes with the idea that perhaps whatever deterioration was occurring might have at the very least stopped, if not necessarily improved. So what's going on here? Are we in fact seeing some green shoots in Europe? If we look at rate expectations baked into futures markets across the major central banks for the end of this year, we can see that apart from Japan, which is kind of this perennially low-yielding environment and has been for decades now, the ECB is seen having the lowest year-end rates of the major central bank bunch, and the U.S. is narrowly near the top. The Bank of England is very close by here, but the U.S. is near the top of the ledger, and clearly there's a big gap here. Europe expected to end the year with rates narrowly below 2%. Let's round it up to 2. Let's round up the U.S. to about 4. It's narrowly under that. That should be about a push. And so there's a 2% yield gap here, give or take, in favor of the dollar. So why has this stopped moving? And why is the euro finding support in it? Well, as ever, the markets don't care about absolutes. They care about the direction of travel. And the question that they're constantly asking is, what have you done for me lately? So they care about where things are going and how those expectations then line up with reality as it occurs. This is the direction of travel. So notice now the Bank of Japan jumps to the top of the list from the bottom because despite having the lowest rates, it is also the only central bank looking to hike this year. We can see that they're on course to add about 50 basis points, somewhere in the middle here between 0 and 1%, let's call it. And the U.S. is the least dovish of the cutters. So we can see here the U.S. on pace to cut about 50 basis points this year, in line, by the way, with what Fed policy prognostications told us back when the Fed updated their summary of economic projections in December. Markets basically lined up with that world view at this point. But what we've very interestingly watched here over the recent days has been a kind of rethink all around on just how much easing is in fact coming across the board. So if you look at this U.S. curve here, what you find is that in the very recent days, it's kind of started to edge lower. And that lines up with the markets now pricing in 56 basis points in rate cuts for the Fed. That's the most dovish that market pricing has been for this year since the middle of December. Notice also that for 2026, which unfortunately we don't have on this chart, we have an increasingly dovish view as well, which lines up with this adjustment. That's a little bit different from what we'd seen before, where you'd get a little bit more hawkish in 2025's outlook. So there was a little bit of give back with a little bit more dovishness the following year. If the following year got a little bit more hawkish, then you'd get a little bit more dovish for 2025. The markets were essentially in this sort of back and forth fine-tuning mode. And what we've seen really since about the middle of this month, in the wake, of course, of this worrying growth data that we've seen out of the U.S., is a more concerted dovish repricing across the entire cycle here through the end of 2026. Now the markets are fully baked in for 27 basis points next year. That's the most dovish that they've been for that outlook going back really since these contracts in the Fed funds futures market had any liquidity in it. The last sort of comparable levels were about 26 basis points, again, back in December, about the first half of December of last year. So we're looking at the markets becoming increasingly more dovish for the Fed. Meanwhile, we can see the situation for the European Central Bank has actually sort of cautiously moved the other way. There's not really a whole lot of movement, but we're certainly not getting any more dovish here as we start the year. And if we look at sort of the overall thrust of what's going on, we can see we're currently baked in for essentially no change next year from the ECB. This year expected to bring 85 basis points in cuts. Consider that basically 3 cuts with about a 50-50 chance of a fourth one. And the picture relatively stable. So we've been in this range here largely for some months. And we can really see it in the direction of travel of the yield curve. So from December of last year to the ECB policy meeting on January 30th, now into today's price action, we can see these yield curves haven't really shifted much at all. And so what you end up with then is a situation where the U.S. outlook, especially in recent days, is getting less hawkish, is shifting toward more easing, whereas the situation in Europe is standing still. And what that seems to be doing is accounting for how you end up with a smaller dollar yield advantage and the beginnings of a euro rebound. This does not appear to be a story of positivity about what's going on with Eurozone growth. Rather, it seems to be a story about deteriorating expectations for U.S. growth and a more dovish outlook for the Fed, and no counterweight on the other side, which of course gives us the results that we're now watching. Now, the next major inflection point from the European side in this story is going to be next week's release of Eurozone CPI. And interestingly enough, it's expected to go higher from 2.4 to 2.5% year on year on the headline reading. And the internals of this really start to stick out. Now, consider it's a fairly even spread here for the various components of CPI as far as the contributions. But when you look at the December breakdown, and of course these will be January figures that come out next week, the one that really jumps out is this hospitality component. So about 0.5 percentage point in this overall 2.4% inflation number that we got in December was restaurants and hotels. Now, of course, we've had a little bit of a pickup from fuel. We can see month on month that's grown in terms of its contribution. The miscellaneous component here is primarily insurance and primarily having to do with autos and energy. We can see there's been a wiggle higher in the transport side that sort of matches that whole story. So it does seem like there's been a little bit more concern around the pricing of energy and everything related, and that's been bidding up costs a little bit. Of course, crude oil has become something that's rebalancing here. We can see down here you had the transport side of things and the energy side of things going from negative contribution to rebalancing to slightly positive, the transport side being negative and then slowly adjusting the other way. This miscellaneous component that includes insurance, that's been negative and now adjusting the other way. So some of what's going on here is just statistical rebasing as you sort of round the horn on year calculations. This restaurants and hotels hospitality component, which you see here in the purple, it's been remarkably stable and refusing to go down, refusing to let go of this baked-in inflation, despite an economic picture that looks, frankly, anemic. We saw the latest February PMI numbers for the Eurozone last Friday, as we did with the US. We can see manufacturing still very much in contraction mode. If you're unfamiliar with these numbers, though we talk about them on the show ad nauseum, they are centered around 50, where that's neutral, neither expansion nor contraction for the relevant sector. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So you can see that going all the way back to basically the middle of 2022, Eurozone manufacturing has been in various modes of contraction, a little bit faster, a little bit slower, depending on when you look. But basically, since the beginning of last year, it's been shrinking at a reasonably steady rate. You can see there's something of a range that's emerged here. But as with the US, it's the service sector that's the outsized part of the economy. And so you can see the composite numbers that follow both manufacturing and services really echo what services are doing, and essentially ignoring, for the most part, what manufacturing is doing, because services are a much bigger part of most developed economies than is manufacturing. And that's certainly the case for the Eurozone, despite some big manufacturing powerhouses in the region, like, of course, its largest economy, Germany. So what you're looking at here then is a second consecutive month now in February that we've held a thin hair above neutral. So 50.2 here is basically an economy at standstill. And it's been close to standstill now, going all the way back to basically the middle of last year. As the attempt from the shallow recession in 2023 to stage any kind of rebound basically falters by the end of the first quarter of last year, things fizzle back. You get a little baby contraction into the fourth quarter of 2024, and now you've basically come back to neutral, no growth at all. Moreover, if you look at what's going on with inflation expectations, they've actually trended a bit higher since the middle of last year. This is the break-even rate for Germany's short-term bonds. Break-even rates are just the difference between analog maturities in real, that is inflation-adjusted bonds, and nominal bonds. When you take that difference between those yields, you end up with the expected inflation that would take you from nominal to real. Right? Nominal minus expected inflation is, of course, what real is. So this extracts that inflation adjustment component. You can see that, of course, more recently you've had a little bit of a downswing, but the trend has been toward rising inflation expectations. And it's difficult to surmise that it's anything other than this sticky component right here, which will not go away despite the anemic economy, which you might think would give you an unraveling of discretionary spending on things like restaurants and hotels. So put it all together and you start to understand why, despite this weakness, you still have inflation that's expected to tick a little bit higher, and policy expectations that, despite that deterioration in the growth structure, hasn't gone anywhere. Surely the ECB doesn't find itself with any more room to cut when inflation is going in the wrong direction, and when the reason it's going in the wrong direction is stickiness in a part of the inflation structure that really should be unraveling but isn't. And so, as we consider what this means in context, we of course come back to these results that we're looking at as of Friday. We can see from about the middle of last year a very strong US and cooling performance in the Eurozone and in China. And there's an asterisk here on the China numbers, of course, because those come out next week. But we learned in our conversation yesterday that the situation in China remains anemic, and we'll link that video here. If you're watching on YouTube, it should appear somewhere above my head here, this link. But just look at yesterday's macro money show, and we unpack it in detail. So the situation seemingly still lining up with exactly what you might expect. An anemic Europe, but with no room for the ECB to do much about it as inflation remains sticky. An anemic China, which recorded the 7th consecutive quarter of economy-wide deflation, and where the recent rally in Hong Kong seems to less so reflect optimism in China's economy coming back, and more so investors having found a way to take money offshore and done that through buying stocks in Hong Kong in part. So no real scope for a big recovery there, at least for now. And the big difference maker, and the thing that likely tips you into a global recession kind of conversation, this rapid unwinding of the U.S. and the service sector as the driving force of that unwinding. Just to remind ourselves here why all of this comes together, these three make up 58% of global GDP growth. The remaining 42% are mainly vendors to the larger three. So think Central Europe, Nordic Europe for the Eurozone, think commodity producers in Latin America and Africa and Asia, and of course Australia and New Zealand for China, think Canada, Mexico for the US is kind of the immediate dependencies. And so what you increasingly start to see is, if this leg gives way, if the U.S. part of this gives way, as it now appears to be, there is no safety net. And despite what we might be seeing from the euro, despite what these shifts in relative yield seem to imply at surface level, you don't have a positive growth story in the Eurozone, nor a dovish central bank story to offset it. And if what we're seeing in the U.S. is going to be lasting and a larger decline than just a 2-month run, well, then it becomes difficult to see how you don't end up in a global recession at some point this year. And that is macro money for today. As ever, we are here right after overtime, Monday through Thursday. That's a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what might follow. I'm on with Chris Mondays and Fridays for Futures Power Hour, on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter, as well as on Blue Sky. If you're watching on YouTube, like and subscribe. Happy trading. Macro Money's back tomorrow.
Dear Cheapo Airlines, thank you so much for sending my luggage on a magical side quest instead of my planned destination. I am glad that I had the sustenance of the single pretzel I was served on board while I was waiting for my bag to arrive. Looking forward to your reply, because surely the response can't be as delayed as long as my flight was. Warm regards, Bettina.
Sometimes get even smarter with live trading insights and some live taunting.
Every day I do God's work here.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top weekly recap.
You just mentioned AI a moment ago. Would you like to see some of the evils of AI? All you had to do was look at this picture. You got the evil of AI.
This was very disturbing. So this is you and me as a mashup? I don't know who did that, but whoever did that should be fired.
Well, maybe you can get to it.
Please make that go away.
In the world of options, somebody once said, for every gimme, there's a gotcha.
It's all about generating positive expectancy in your portfolio.
Welcome to Option Trades Today. I'm Tony the Bat Batiste, and I've got not one, but two trade ideas for you today.
Exploring zero DTE. We promised you we would take a look, and here we go.
Looking for a better broker and a bonus? Sweet. We got you. Right now, you can get a bonus of up to $4,000 when you open and fund a Tasty Trade account. Plus, low rates, smart tech with the analysis tools you need, and award-winning support. So, get a broker who's actually got your back. And up to $4,000 at Tasty Trade. Make your move, genius. Tasty Trade.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace, and today I'm flying solo. We've got a special episode, I suppose, planned here today, even though a lot going on in the market, which towards the end of the show I'll get to. We've got a performance dashboard and expected moves to run through. But we've had a ton of questions recently on the Tasty Crypto support side of things. If you do have a question for us, you can hit us up at support@tastycrypto.com, send us an email, or hit us up on Twitter at Tasty Crypto. But we've had a lot of great feedback, a lot of questions recently, and I want to take the time today to run through a demo and talk a bit about the Tasty Trade crypto product offering. We're going to talk about enabling cryptocurrency trading, and also transfers. And then we're going to jump over to the Tasty Crypto app, where I want to walk through some of the features that I find pretty useful in the app. We also have the ability to connect to your Tasty Trade account in that app. So we're going to show you how to do that. And we're also going to talk about some of the features that are upcoming in the new build that we've got going to the App Store here pretty soon. So excited for today's show. If you're not watching over on YouTube, no shade on tastylive.com, but get over there because you can pop into the chat, and I want to open it up to any questions, and we'll just fire away kind of throughout the show. I'll take those questions, and I guess if they're related to anything that we're talking about with the apps, happy to go through that, or just generally speaking crypto questions. we'll take those as well. So we'll see who shows up here. Hope everybody's having a good day. If we jump over to our slides really quickly, again, just a quick overview of what we're going to talk about. Enabling crypto trading. This is at Tasty Trade. Transferring crypto. And then we're going to look at connecting Tasty Trade to Tasty Crypto. And like I said, talk about some of those new app updates. But we got Big Deal Donuts in the chat. What's going on? I love the cherry emojis there. If you are watching on YouTube, I used to say this as a true streamer back in the day. Subscribe to the channel if you're not subscribed, and hit that like button, or as I like to say, throw some dollars up here on the stage. I'm dancing for you today. So let's jump into the demo. And the first thing that I want to do is talk about the product offering. If we could throw up the browser here, talk about the product offering at Tasty Trade. So if you have a cash or margin account and you want to trade crypto at the Tasty Trade brokerage, you'll need to enable crypto trading first of all. Your account is a fully disclosed account with zero hash. That is the crypto custodian. You can kind of in some ways think about them as the, similar to Apex or the custodian that exists on the securities side. But in order to do this, you first need to enable crypto. So that's step one. And you can do that by going over to tastytrade.com, and you can see that we have the site up here. But you go over to tastytrade.com, log into your accounts, and then underneath My Accounts on the left-hand side, go down to Trading Preferences, and click on Trading Preferences, and you can see that with my account here, I have that crypto trading enabled. So if you don't have that enabled, you'll see that you can click this button over here, and that'll give you a couple forms that you want to be aware of. You can look at those documents, and then you just click another button, and you're good to go. You also have the ability to enable other features such as futures margin, futures trading here on the screen, and then also portfolio margin if you're interested in that as well. But this is all on the Tasty Trade website. Again, log in, go over to Trading Preferences, and step one, enable cryptocurrency trading. And then when you do that, in a cash or margin account, you can trade one of the 7 tokens that we offer here today, or that Tasty Trade offers. There are more coming soon, so I hear, but today you can trade spot Bitcoin, Bitcoin Cash, Litecoin, Ethereum, and more recently, Solana, XRP, and Doge. So expanding the offering, but those are the 7 tokens that are available. And if you're interested, go back to the summary here. We have some great courses as well. You also have to log in, so just use your Tasty Trade username and password. But if you log in there are some great crypto-related courses on the trading platform and cryptocurrency in general that you can access right here by clicking the Get Started button. So that's the first thing that I want to cover. The next thing that I want to talk about is transferring crypto. So in addition to being able to trade the 7 tokens that I mentioned, you can also transfer crypto using your brokerage account. You can kind of treat the account as a wallet. Technically, that's what it is on chain. You can deposit cryptocurrency at the brokerage, and then you can hold it in your account, or you can choose to sell it if you wish. Or you can buy crypto through Tasty Trade, through zero hash, and withdraw that crypto to an address that you have control over. So maybe it's through the Tasty Crypto app or another self-custody wallet, or you simply want to send it somewhere else, cold storage, whatever you want to do with that. You have the ability to transfer crypto and kind of treat the Tasty Trade brokerage, or at least I do, as like a store, a little crypto store. You can take it home with you, take it on chain to that wallet address that you control, and do whatever you want with it. If you want to swap it for other tokens that are available on chain through a decentralized exchange, you want to create liquidity pools, you want to stake it through a protocol like Lido, you want to buy some NFTs, it's up to you. Whatever you want to do with it, you can withdraw that crypto after you purchase it through Tasty Trade. But in order to do that, you first need to enable cryptocurrency trading. Once you've enabled cryptocurrency trading, go over to My Money. You'll see that there's a cryptocurrency transfers section here, and you'll have to take a couple more steps. I've gone through this process already, but you'll need to enable 2-factor authentication on your account, and then you'll also need to just re-verify your identity. And once you've done that, you can go in here, you can add a wallet address that you want to withdraw to and that you want to deposit from. And once you've done that, you'll have the ability to transfer crypto. Again, you can deposit crypto. You can also withdraw crypto right here. And so let's just take a quick look at how you can do that. So on this page, click on cryptocurrency transfers. As you can see, this is a list of wallets that I've used previously. Click on deposit, bunch of language that you can read some of these disclaimers. But if you scroll to the bottom of the page, you have the ability to generate a deposit address. But first you need to pick the cryptocurrency that you want to deposit. And also, what's up, Jose? Nice to see you in the chat. Nice to see the gangs all here per usual. So this is how you do it. Really straightforward, really simple. One thing you want to be aware of is that when you're sending cryptocurrency, whether this is withdrawing it or depositing it here at the brokerage, you want to just make sure that you're on the right chain. These are different blockchain networks. Bitcoin is obviously different than Ethereum, different than Bitcoin Cash and Litecoin. So if you're sending Ethereum to an Ethereum address, make sure that it is in fact an Ethereum address and you're not sending Ethereum to a Bitcoin address, for example. So just make sure that you selected the correct asset here. Then you can generate that deposit wallet address, and it's really easy after that. You simply just take that deposit address, and that is the one that you're going to use when you send the cryptocurrency from wherever you currently hold it, whether that's in your self-custody wallet or it's at another exchange account that you might own. If we scroll to the top of the page and click on withdrawal, this is how you move that crypto out to the wallet address that you've chosen or that you've added here previously. And again, the same rules apply. I can't stress this enough. Make sure that you are using the right blockchain network address for the asset that you wish to transfer. So again, if I want to transfer ETH, double check the address always and just make sure that you didn't accidentally select or you're accidentally sending it to a Bitcoin address. Make sure that's not the case. And so you go down here and you select the asset that you want to send, and you'll get that address that you can also deposit to if you're going to deposit. So a couple quick things or quick points to cover around the broader crypto offering at tastytrade. Again, step one, if you want to trade crypto at tastytrade, right now it's only available in cash and margin accounts. You need to enable crypto. So if you just opened your account and you haven't enabled crypto or you want to trade crypto, you can't do that unless you've enabled it. So make sure that you enable it. And then if you want to transfer it after you've purchased it, it's available to withdraw in your account, or you want to deposit crypto to your account, you need to first turn on those transfers. So now that we've got that out of the way, I want to talk a little bit more about the Tasty Crypto app. This is something that we're certainly excited about here and have been working on for a couple of years now in terms of the broader development timeline. And you can see it here on the screen. We've got a lot of new features coming that I'm going to talk about as well. If you have any questions about the app, if you're an app user, please type it into the chat. But before I talk about what's coming next, let me show you what's already in the application. And the first place that I want to start is around connecting tastytrade and Tasty Crypto together. These are separate applications. So there's a little bit of confusion. You have the tastytrade crypto side of things, and you have the Tasty Crypto wallet application. What we have on the screen here is the Tasty Crypto wallet application. This is going to give you those self-custody capabilities, allows you to be really truly in control of your crypto, full ownership. And what I mean by that is that you are in control of your private key. You can sign transactions. Everything is on chain, but when you trade through tastytrade and through Zero Hash, you don't hold the keys. The keys are held by the crypto custodian, in this case, Zero Hash. You have control over your crypto. The platform gives you the ability to buy crypto and to transfer it, but you can't actually go on chain and interact with, let's say, a decentralized exchange or do more with your crypto. In order to do that, you'll need a self-custody wallet. So not only is this a wallet, it's really a platform that gives you access to on-chain opportunities, DeFi, NFT marketplaces, etc. Everything that you might want to do with your crypto, you can through the Tasty Crypto app. So first, I want to just talk about how you can connect to tastytrade. A couple of ways that you can do that. You can click on the Add button here on the screen in the upper left corner. And when I click on that, you can see I've got a couple of choices here. Maybe you don't have a tastytrade account, but you have a PayPal account and you want to use that to purchase crypto and control it with your app. you can do that. You can also use a third party such as Transact. Similar to PayPal in that you can connect it, use a debit card, and buy crypto, and then it's shortly available in the application. Say within 30 seconds or so, that ETH is on chain under your control. But let's say that you do have a tastytrade account. I've already logged in, but you will click on this and you'll be prompted to then log into the account. And it'll take a second here to just load up, but these balances should load in just a second. But I know that this one at the bottom is the one that I have crypto in. If I click on this, it'll give me two options. I have the ability to buy crypto. And if you're in the current version of the app, you're not going to see this because this is a feature that in this version, I wanted to show on air today, but we haven't yet released to the store. We're planning on releasing this towards the end of the week, so hopefully by Friday. And then pending approval by Apple, by Google in those app stores, this should be available for download or for update on your phone here, hopefully within the next week or so. And you will see that buy crypto functionality in there. Today, in the current production version of the application, you'll just see the ability to withdraw crypto. So let's say that you want to do that. You have crypto at tastytrade. You want to move it to this address that you control through this application so that you can do something with it. Maybe you have Ethereum that you want to swap into something else and you want to use it on chain. In order to do that, you simply just need to click on withdraw crypto. And then in a second here, it'll load up the crypto that is available to withdraw. So you can withdraw Bitcoin, Ethereum, and Solana from the account that I have. Those are the cryptocurrencies that I hold in that account. If I wanted to withdraw Ethereum, simply just click on Ethereum, and then I can type in the next version, you should just be able to type in the dollar amount. But I think here today, we'd have to type in the crypto amount. So I can type in 0.01. It's about $23, a little bit less here today after the price action in the market. But I can now move that $23 from the wallet that's controlled by Zero Hash, by tastytrade, to the wallet address that I control through the app. You'll be asked to review the transfer, and you'll be prompted to enter in that 2FA code. So again, you need to have the two-factor authentication turned on for security purposes with the brokerage account. But once I do that, I don't have the authenticator app here on this phone, but assuming that I entered that code, I'll then be able to move that cryptocurrency to the address that I control through this application. And it's really as easy as that. So initially, I went through the tastytrade website and showed you how you can withdraw crypto or deposit crypto using the website. If you have the Tasty Crypto app, it's even easier. Simply just log in, click that add button, click tastytrade. You'll be prompted to log in, click the OK on the disclaimer, and then you can move that out. And you can do that with Bitcoin. You can do that with Solana as well. Now, this app does not support the Litecoin network or the Bitcoin Cash network just yet. So these are the ones that you can move out there that I have in the account. Also want to just quickly show the feature that's coming soon, which is the ability to buy crypto. I'm super excited about this. It's easy to buy crypto through any of the tastytrade platforms. There's some great updates coming to those platforms as well, specifically the mobile app very soon. But once this is out, the new version of the Tasty Crypto app, you'll also be able to go in here, and this is really slick. You can use this interface to buy crypto. It's somewhat limited. It's kind of the MVP initially, where you can only buy it using a dollar amount, market order. So if you want to use a limit order, or you want to change the amount to the actual cryptocurrency, you can do that through the other platforms. But here we've made it super easy just to go in, click on buy crypto, and here I can buy ETH, Bitcoin, Solana, Litecoin, Bitcoin Cash, eventually Doge, XRP, anything that's available through the tastytrade brokerage through Zero Hash, you'll be able to do that. But let's just say that I want to buy $5 worth of ETH. I can see that my cash balance here is $325.25. So that's the cash that's available in my tastytrade account to purchase crypto with. If I want to buy $5 worth, I'll just hit that 5, hit the review button. Here are the details for the order. This is kind of your confirm and send page. Place buy, and in a second here, we'll see that order is filled, and boom, I've just purchased $5 worth of ETH. You can see the market price that I was filled at, $23.50 or so. it said there. So this is, again, in your Tasty Trade account. It's just a different interface if you'd like to use this in order to trade in that account. You can kind of think of this as expanding the footprint or the number of locations where with your Tasty Trade account, assuming that you're logged in here and it is a cash or margin account, you can buy crypto through the Tasty Trade app. The next step for us is to hopefully allow you to simultaneously purchase it and send it. So give you the same functionality that exists with the transfer side, but allow you to do this all at once where you can come in, buy crypto with the cash that's available, and then transfer it on chain immediately so that you can do what you want with it. And then, of course, if you want to move it back and you want to trade it, you can do that as well. So that's one way that you can do it. One other thing I just want to point out here is the menu. And you can see that I am connected to the Tasty Trade account in here. If you want to log out, you can do that. Just click on the button. But that'll tell you whether you have an active connection. If you aren't actively connected, then you can go in here and you can log in. But you can also, again, do that from the assets page. So let's talk a little bit more about what's here on the screen. When you look at the coins page, this is all of the crypto that I hold across multiple blockchain networks that I'm viewing through this single application. So what I love about the Tasty Crypto app is that is multi-network. So this is something that's going to give you access or control over your crypto on the Bitcoin blockchain, the Ethereum blockchain network, also on Ethereum L2s or layer 2s. So scaling solutions like Polygon, but also layer 2s like Base from Coinbase or Optimism, Arbitrum. Additionally, you have the ability to trade and control your crypto on Solana. We're bringing more chains to the wallet, but those are the ones that are available today. And you can see as I scroll through this, I've got a bunch of stuff that's all over the place. Some of the things that unfortunately didn't go so well for us during some of the bag battles. If you caught that, prior to this more recent downturn, we got some of that stuff left over in here. But you can see that we're on Base, we're on Ethereum, we're on Solana, and so on. And there's an indication next to the logo. I know it's a little small on the screen, but you can see the network that it's on. So you could have, in some cases, Ethereum or a balance on the Ethereum layer 1. You might also have Ethereum in terms of the token that you hold on the Base network or on Polygon or Arbitrum. You might have USDC on those networks as well. So that's the US dollar stablecoin. You also might have that on Solana. You'll see what networks those are on when you look at that little logo there. So here's USDC on Solana versus USDC on Base. So now let's say that you have these balances and you want to trade something that's not available directly through the Tasty Trade brokerage. As I mentioned earlier, there's currently 7 tokens that are available. We're working to expand that token list as quickly as we can. But if I do have something here that I want to trade and I want to swap this into any other token that really exists on chain through a decentralized exchange, you can do that directly in the wallet. So all you have to do, if I go back, is just click on the balance that you hold. So again, we'll go to USDC on Base. And you can see some details for each one of these. So this is the coin details. You can see the market cap. You can see the rank in terms of market cap. So obviously USDC is going to be one of the larger tokens, even though it's just the dollar. You can see the correlation with different things across different tokens at times. But let's say that we're just looking at a stable coin, so there's not going to be much volatility here. But let's say that we want to swap this. We want to trade it for something else. All I need to do is, you guessed it, click that swap button. And now I can select any other token as long as it's on that same network, right? I'm not going to be able to, with my USDC on Base, at least not today. We've got cross-chain swaps coming, but not today. I won't be able to go in there and, let's say, swap that for something that exists on Solana. So if I want to trade on Solana, I need USDC on the Solana network. But I'm on Base. I want to trade on the Base network. Maybe I want to buy more of the Virtuals protocol. I select Virtual, just like you would select a stock symbol or any other token when you're trading it in dollars. And then I just select the amount that I want to trade. So if I want to buy $10 worth of the Virtual token, You'll see what that looks like here in terms of the amount that I'd receive. So there's going to be a little bit of a fee, and at times, depending on the dollar amount that you're trying to trade, could be a little bit of slippage depending on how much liquidity is available on chain. But once I have that refreshed quote, I'm going to click Review Swap. And then when I swap this token in a second or two, it's going to submit that transaction, and it's ultimately going to let me swap that token. So it might take a moment here to load. But that's how you do it right here within the application. Very easy to swap from USDC to any other token. You can see the transaction is processing now. And then once that's confirmed on chain, those balances will update, and I'll have more of the virtual token and less of the USDC that I started with. So really easy, again, to swap here in this application. That's what I love about it, is that it opens up kind of a world of possibilities that exist on chain. And the way that this works is it uses liquidity from decentralized exchanges. So if you watch Tasty Crypto Show, we've talked about Uniswap, we've talked about on Solana, Jupiter, Radium, a lot of these decentralized exchanges where it's P2P, there's no intermediary. You just kind of go through the code base in that sense. It's all code. And it allows you to swap tokens one for another, trade them, as long as there's liquidity on the exchange. And so what happens in the background here is we aggregate liquidity from a variety of different decentralized exchanges, get you the best price, the best quote, and then route that order and allow you to swap all without an intermediary. You do it right here in the application. And again, you do that simply by selecting the token, or you can click swap here at the top, and then you can decide what asset, based on what you have, you want to trade across those different networks. So again, really easy to do that here in the application. If you buy ETH, let's say, at the Tasty Trade brokerage, you can move that to this wallet, and then you can swap that Ethereum. You don't need USDC. That was just the token that we used for the example. But you can swap Ethereum, eventually USDC from Tasty Trade. But you can swap Ethereum for any other token across these networks, or you can use a DEX like Uniswap on the DeFi tab here, which we'll show in just a second, to bridge that to another network. So now I want to jump over to the DeFi tab. This is something that I use quite a bit, and we're constantly working to make some improvements here. But this is going to be the launch pad for a lot of decentralized applications, or dApps as they're commonly referred to. You can see Uniswap is here, PancakeSwap, Aerodrome, that's a decentralized exchange on the base network. You can also enter a URL, and you can go to an application that you have the URL for. You can connect to it. I would just caution everyone to make sure that they understand what they're connecting to and what transactions they're signing. Just be aware of that, because there is some security risks at times if you don't know what you're doing or what you're signing. But let's say that I want to use Uniswap, and I've gone through here earlier, and I've connected to this, but I click that Uniswap icon, and it's going to take me to the Uniswap application. If I click on Connect, I've got the ability to then connect the Tasty Crypto app, click that Connect button one more time, and now this is going to read the balances that I have at this address across those different networks, whether that's Base, or it's the Ethereum blockchain, or it's Optimism, Arbitrum, you name it. As I go in here, I can then swap any of those balances that I have, also using Uniswap. I can also now go and create a liquidity pool. Previously, and it's been beaten up quite a bit, as you can see, I had a virtual WETH, or wrapped ETH pool here. So virtual token with ETH base. Going in here, you can see that we're out of range, but this is where you can go in and you can manage your liquidity pools. You can put liquidity pools together. You can use applications like Uniswap. You can do that all through this DeFi dashboard. Additionally, as you trade, as you have activity on chain, if you want to see any of that, you receive tokens. I mean, there's the swap that we just did earlier where we swapped USDC for virtual. You can see all of your activity here. If you click on any of these, you can also then click that completed button. When you tap on that, that'll take you to the blockchain scanner, or ETH scan, Sol scan for Solana, base scan. That'll allow you to then investigate the transaction. If you ever have a question about it, you want to look at a balance if it's not updating for one reason or another in the application. You can view all of that directly on chain. When you go to the activity here, you can also filter this and look for transactions by address or keyword. Additionally, if we just jump back to the assets page, you have the ability to send and receive crypto, obviously, with the wallet application. You have the ability to see more details on these token details pages. So if I want to look at relative performance on the day for Ethereum, at this point, a little bit better than Bitcoin, up 2% against itself. It's just going to show you 0. You can see the range on the day. So a pretty volatile day for crypto in general. Also have the ability to see some news and the activity here. So that's, for the most part, an overview of the application. I'm probably missing a couple things. This will allow you to manage multiple addresses within a single application. So if you ever see something where the balance isn't showing, the first thing I would check is just to make sure that you don't have multiple wallets that you've imported or created and you are just on the wrong one, right? If I go to this wallet 1, I don't have any balances, but if I go back to, the wallet that I was in, you can see those balances load again. So this gives you the ability to not only manage assets across multiple blockchain networks, but also gives you the ability to manage multiple wallets, which I love. And we haven't touched on any of the features that are coming soon aside from the buy feature. We're going to do that in more detail once the new version of the application is available for download, which, like I said, should go to the stores for review by the end of this week. And then as long as we don't have any issues, should be available for download the following week. Hopefully as early as Monday, we'll push that out for update. But that is a quick demo of the tastytrade crypto product. Enabling cryptocurrency is step 1. And then if you want to transfer, you want to move that to a wallet address that you control on chain, you can do that. Just make sure that you have cryptocurrency transfers enabled as well. You can do that all through the tastytrade website. Just go to tastytrade.com, click on log in, and then you can manage your account. And if you do have the Tasty Crypto app, you can connect it to the tastytrade account. You can do everything that we just talked about here today on the show. If you don't have the app, it is available for both iOS and Android, and also available as a browser extension for the Chrome web browser. But that's going to do it for our show. If you have any questions, if you are a user of the application, we love feedback. It's still kind of early days for the development timeline. So if you have any questions, you have suggestions, you have feedback, bugs you want to report, criticisms, we want it all. Send us an email to support@tastycrypto.com. Join the Tasty Crypto Discord, and also follow Tasty Crypto on X @tastycrypto. But that's going to do it for my show. Victor Jones is up next with The Price of Truth. I'll be back next Monday with Katie McGarrigle. Until then, I'm Ryan Grace. Thanks for watching.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tastytrade. Make your move.
Regulation time may have expired, but the conversation is just getting started. This is Overtime, the post-market scrimmage for market junkies. Join Chris Vecchio, Ilya Spivak, and me, Dylan Radigan, as we analyze the X's and O's for everything from earnings to politics to macro events and more. Nothing's out of bounds on Overtime. We break down the news to provide you a playbook for your trades. Watch Overtime Monday through Thursday only on tastylive.
Twitter versus Facebook. A rap battle. First up, Facebook. Twitter, I'll snuff you out like I did to MySpace. I'ma have to erase your little Twitter face. Warm it up, Facebook, I'm about to. Did they make an Oscar-nominated movie about you? Check my school out, I'm at the top of my class. My main interest is listed as kicking your ass. I help dictators get thrown over. You help the cast of jerseys, you'll get overexposure. I'm too Titanic for you Twitter and twist. You bird-ass tweets, stick to the branches. I'm root deep, universal expansive. Twitter better get lost before you get poked. What? What?
Yeah, this is Twitter. Check it. At Facebook, can I attack you? Yes, and I could do it in 140 characters or less. Brevity's the soul of wit. I'll make this quick. Hash mark. Facebook is a dick. Retweet. Yeah, I'm backing that ass, and I'm young and I'm brash, and I'm packing that cash. Stick with the kid, I'm an early adapter. Your old Facebook played out like Napster. I make it real easy for family to talk. I make ex-girlfriends real easy to stalk. I show you life in real time that's completely amazing. I show you which celebrities are totally crazy. From Blitzer to Sheen to Kanye to Rom. I run with stars, Facebook is a place for your mom. What's the matter, Zuckerberg? Don't like how that sounds? I got a million customizable backgrounds. You're so totally boring. My card's on the table, hash mark. Facebook is disabled.
If you say way to go out on a ledge, what are you doing?
Way to go out on a ledge is just another expression when you make fun of another trader who's not willing to take any risk, who's very risk averse. So when somebody's very risk averse and doesn't want to do anything risky, you say, "Hey, way to go out on the ledge."
When you say you're going to whack the bid, what are you doing?
When you whack the bid, that means you're selling at the best available price.
A scoopy. What's that?
Scoopy! That's one of my favorite. That's when you're just like scooping something at the bottom, like, you bought something and it never goes lower. Scoopy.
Back in the pits, you guys call them teenies. What are teenies?
A teeny is a 16th. So before we went to decimalization, we used fractions. And we used 16ths under a certain dollar amount.
Do you want the penny or the position?
Well, that's always something. The penny or the position is, do you want the trade? Then just pay up to get the trade. But do you want to squeeze it for a penny? That means you're just going to wait until you get filled.
When you say Omaha, what happened?
When I hear Omaha, I know I've gone too far.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Oh, yeah, it's Wednesday, February 26th, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's evening show, little podcast, little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world, and good God, are they throwing incentives out like hotcakes every single day. But we're here to field them, and more than that, we've got the big brain with us to help us figure out what the is going on with the world. I'm talking about none other than Mr. Chris Vecchio. Chris, how you doing, my friend?
When you start with Wednesday like that, I think of the Family Guy sketch, the wacky waving inflatable arm flailing tube man commercial. I don't know why, but that is
I don't know.
Yeah, well, you're not going to hear me repeat it because I'm not that fast of the tongue. But anyway, happy Wednesday to you, sir.
Happy hump day to you too, my friend. We were talking about nostalgic programs we used to watch that sort of have a little bit of sexual assault in them in the green room.
You put me on the spot the other day as if I'm throwing racial epitaphs around. You're talking about Pepe Le Pew.
Well, Pepe Le Pew, we're talking about First, The Sandlot, when Squints pulls the move on the lifeguard, and I was like, that's a sexual assault scene, and they kind of made it okay when the lifeguard kind of waves at him afterwards. They just they papered over it. She was okay. That's some sort of like consent. Everything's fine here. And then Pepe Le Pew.
No longer creepy now, right? She's okay with it. Tough message to send to the kids, but
yeah. So I'm curious. Do you got any others? Any others like that were really sort of like you watched them as a kid, like Snow White's kind of. Isn't Snow White, going up and kissing somebody when they're asleep? Isn't that a little essay?
Yeah, Disney and Warner Brothers frequently put those like not trailers, but they go ahead of the movie, right? And they edit the language like these cartoons are from another time. We're not editing them because to do so would be whitewashing history, basically. So you have to understand what people think and felt, but like we're not okay with it. But I mean, like most of the content back then has something in it that may not be perceived as couth today. But what I find particularly funny, Victor, is now that I like rewatch a bunch of these cartoons and movies with my kid. When I was a kid, I'm like, oh, the parents are so mean. Like this little boy just wants to explore the world and be a hero. And now I'm like, yeah, the parents got a point. What does he think he's doing? Like, you're no hero. Get back in bed.
No, bro. I go back. You ever watch The Newsies? You ever seen this movie? The Newsies? Yeah. Bro, like those old school New York kids selling newspapers, smoking cigarettes, hustling for money. We are so far. I can't even imagine letting my kid go out for 8 hours, not knowing where he's at, and then coming back like, "Hey, son, did you bring home your salary?" I can't imagine that world.
Yeah, I'm actually.
I'm trying to buy a geo tracker to slap on this kid so I can know his whereabouts at all times. That's a different world. Anyway, somehow that's the open. Anyway,
again, whatever that
that's the open. Welcome, everybody. Shout out to everybody who's still watching somehow, some way on tastylive.com. Shout out to everybody that's watching on Tasty Trade desktop and mobile application, waiting for us to get to something somewhat market related. But if you want to be part of this little chat box on your screen, there's only one place to do it, and that's on the evil Google YouTube. So head on over there. Jump in the chat, move your phalanges, metacarpals, or just slam your face across the keyboard. Doesn't matter. Random ass characters will suffice so we can spoof the Google algorithm into putting us in front of as many people as possible. And I don't know, maybe deprogram the world a little bit. Chris Vecchio, last time I talked to you, I think we were on the other side. We've been in like this 6,000 plus or minus 200 range. We're on the other side of it, 61-ish. And the market has taken just a bath for a couple of days straight. We're at 59.76, but vol is, I'm arguing, relatively subdued here, still sub 20. I had a conversation with Ilya yesterday. Ilya argues, and I would, it's hard not to argue this, that those horrible PMIs from last Friday, along with poor home sales, just a litany of garbage data, kicked us off. Was the catalyst from last Friday. Where do you stand on risk here at 59.75 on the other side of 6,000 here? What's your take on what just transpired over the last 4 days?
Sure. Well, I mean, if we had met a week ago, I would have been on here banding about how the stock market was closing at a fresh all-time high and how quickly things have changed. The fact of the matter is right now, it feels a little reminiscent to what happened in July of last year when the market got over its skis and all of a sudden the attention swings from is inflation being defeated to, whoa, do we have a growth problem on our hands? And it was those non-farm payrolls data, the triggering of the SOM rule in August that ultimately provoked that type of market mindset. And it seems like we're going through that right now. Unlike what we've seen 2023, 2024, when interest rates dropped, stock markets went up, particularly the Russell would go up, because it meant that the Fed was able to cut rates thanks to inflation being lower. And the golden goose was still there. The Goldilocks world of strong growth, 2 to 3% in real terms, unemployment rate with a 4 handle, CPI heading back towards the Fed's target. You could justify, okay, this is good, right? Yeah, lower rates, good for stocks. But in this world, the past few days especially, we've seen lower rates come in and stocks just haven't been participating, or at least seeing them as gleeful. And it's because it feels like that focus point has shifted from growth, well, from inflation being a problem to wait, we have growth now in our spotlight of fear. And so to that end, that's what you see last summer, right? You now have another market environment defined by the fact that it doesn't really matter what's happening with the inflation figures. It doesn't really matter what's happening with the inflation trackers. We have PMI data that says the economy may be slipping back towards recession. We have weak Dallas Fed manufacturing. We have weak Chicago National Fed Activity Index. The home sales figures aren't great. And altogether, you have growth fears accumulating all of a sudden once more. And then you have a federal government which, for all intents and purposes, it says it wants a lower 10-year yield. It looks like it's getting it, but for all the wrong reasons.
But a lot there.
Can I add one more layer to that? And I brought this up twice today, but for the third time, you haven't heard me say this, but for the sake of the audience, once more, forgive me.
How do you know? How do you know I don't watch you nonstop on the network?
I know you do, but it's just the beginning of your day. So you have all day to catch up on what I said. We think about the difference between types of cuts. And this is a topic you and I have discussed in the fall of last year when the Fed was beginning their cut cycle. And it's, what type of cut are we getting? Is it for maintenance reasons? The Fed can just back off a little bit. Is it for a recession? The economy's slowing down. Or is it an emergency? Oh my gosh, something just happened. We didn't expect it. We have to cut rates immediately, like COVID. And I argued at the time this was a maintenance cut. And the returns of the stock market after maintenance cuts, 3, 6, 12 months out, are all positive. But it seems that the market's now thinking that forthcoming cuts would be the recessionary kind. Why do we say that? Because after CPI, we had, 2 cuts priced in through the end of next year. Now we're at 4. Interest rates are lower as those cuts have come in. And instead of rejoicing over more interest rate cuts appearing on the horizon, the stock market has taken, a 4% leg lower in the interim while those cuts have been built up. That, to me, is a clear indication that the market's now thinking rate cuts, if they do come, are not because inflation has been defeated, but it's because of recession. And when you look out stock market returns, when the Fed is cutting for recessionary reasons, that's bad a month out, 3 months out, 6, 9, 12, right? It's just not good. So then you go over to your sector performance recently and you see that XRT, the retail sector, hasn't been performing that hot. And XLP has been on fire. And healthcare, another defensive name, has been doing well, while XLY, granted there is a Tesla component into that, but XLY has been struggling again and recently just set lows. So the sectors don't look great. The backdrop is looking a little less accretive for more gains in the near term. It feels like there's a lot of macro risk, and the market really does now care more about growth. And you can see it in the cross asset flows and how yields aren't triggering the type of euphoria in risk assets that we saw for stretches of the past 2 years.
Yeah, really quickly, to your point, just to throw this up in front of everybody, these are the sort of the cut expectations for until the end of 2026. There is the continued expectation of a cut in the June meeting that we flirted with either June or July. It seems like it's firming up in June with an additional one in September and early cuts in 2026. The markets move that back and forth between December and January, and then another one in the tail end of December. So you've got 4 cuts there from now to the end of next year, as Chris just mentioned. And previously, if we take a look at the yield curve, this red line is where we were in September when you got that jumbo cut. And what's happened is more cuts or more implied cuts have tended to yield to the long end of the curve actually lifting. But all of a sudden, you are not getting that same relationship where additional cuts are leading to a long end that's lifting. You're seeing the exact opposite. The whole curve, the yellow line now is the whole curve is falling, and it's falling precipitously. We're now under where we were when we had the cuts in December. We're now under, the curve has fallen to below where we were when we had the cuts in November as well. The difference is sort of the shape of the curve is a lot different. We were inverted going up, and we're staying sort of uninverted on the way down. So the whole curve is moving lower. At the same time, more implied cuts are being priced in, which is a completely different scenario than we've seen for the last 4 or 5 months. To Chris's point, and we pointed this out yesterday as well. So I guess my point to you is there it seems like there are a lot of underlying dynamics in the market over the last week that have changed. That doesn't necessarily have to stick, right? All of that in the next week or in the coming weeks can be undone. We can go back to the previous correlations that we've seen up until this point. My question to you, Chris, is from your point of view, it seems like from that open, you believe, as Ilya, I think, did yesterday, you sort of believe that we might have just hit this transition point in the market where whatever was up until last Friday is now something new. We have sort of a new market dynamic to work with, and this isn't going to be short-lived. Is that fair, that your confidence interval is pointing towards a pathway where we're going to have new market dynamics where growth, the market is dealing with growth slowdown, and that looks very different than where we were before with high growth and high sticky inflation?
It does feel different, and you can see the market caring more about, the potential impact of the tariffs and trade wars, if you will, because the economy is signaling that it's taking these concerns a little bit more seriously. We may feel from following the news so closely and living on social media, particularly Twitter, that we've come to understand the boy who cried wolf nature of some of these tariff threats. What do we find out today? Have the Mexico and Canada tariffs been pushed back again, Victor? You bet. But you know what? We're traders. We're not people who own and operate businesses who have to project cash flows. And we can see in the survey responses, in the consumer confidence data, in the PMI data, that this uncertainty and the will there be tariffs or won't there be? Is it a negotiating tool? Not. It just, as a business, that's just not something you can entertain. So the uncertainty that these businesses are facing in the surveys are skyrocketing right now. And that is something that does cause an overhang in the economy. It goes from being bluster that we've interpreted as for the first few weeks of the administration to, well, if people aren't confident about the future, they stop spending. If they stop spending, then hiring slows down, and yada, yada, yada. And then it becomes self-fulfilling simply because everyone decides to take a step back and take a beat at the same moment to get their bearings. And didn't this happen in COVID? Everyone kind of just stopped spending all at once. Yeah, there are shutdowns. But when everyone stops spending all at once, everything can come down really quickly. So that's a dynamic here that while we as traders have said, okay, yeah, it's fade the gap. It's another weekend gap. It's starting to appear in the data, right? And now that it's actually appearing in the data and it could slow down growth, that sets up nasty dynamics where structurally higher inflation coupled with slowing growth and higher unemployment. It's not stagflation, but it certainly, has that Pepe Le Pew whiff to it, Victor. That doesn't make you comfortable.
Nice callback. Interesting. Okay, let me ask you. We've been talking about the 6,000 plus or minus 200 range for the last 4 months, and I think that was even you sort of expected that coming into the year. So why there tends to be at the upper end of the range a feeling of general euphoria, right? That it's hard to find bad news. At the low end of the range, it's hard to find good news. Can I ask why shouldn't I just be trading the range here? Why shouldn't, when assets are getting cheaper, why shouldn't I be looking to add on to a portfolio of longs when assets are getting cheaper? Why should I be sort of jumping in bed with the negative narrative that is creating a discount in assets?
I don't know. So to take a step back, I think I've placed 2 trades in ES this year, right? Like it's been range bound. I'm a momentum guy. This thing has been grinding. I've taken some stabs and it looks like it's getting some acceleration and then it's petered out. So it hasn't, and I haven't placed any trades in NQ, just to No reason. I mean, I'm looking at my chart right now. Maybe it's a double top, maybe it's a sideways shift, but at 59.72, Victor, you talk about trading the range. The range is 200 points wide of exactly where we are right now on either end. We are literally in the midpoint of where the market has traded since basically late September. And so you got a little bit of vol here. Maybe the prudent thing is it's February 26th. We know that the seasonal tendency of the market is to grind sideways into the Ides of March. Slap on an iron condor, short iron condor. And if we get to the range lows, look to do a little bit of a scoop. And if we get back to range highs, look to sell some calls. But until March 15th, a lot of chop. And I think perhaps even more consistent with the, thesis that comes out of DeepSeek. I think it was Wednesday, January 29th, we spoke, or maybe it was the week after. But if a phase 2 transition is occurring, then you'd expect a lot of chop in the headline indexes for some time. And that comported with the seasonality. So I haven't really, I've taken my chips, like 2 shots, chip shots of trying to get long stocks in some capacity, but never have really loved it. And now the golden goose of why I really like being long all of last year, like check the economic scoreboard, everything's fine. That's moving in a direction that makes me less comfortable with just buying every single dip.
But you're but you're not a trader though. You're like a long-term guy. No, what I'm saying is, I would expect a long-term point of view as assets get cheaper to want to start to switch into accumulation mode. You get what I'm saying? That's what I'm saying.
Accumulation. Okay, so if we're thinking about this on a longer-term basis, just if I'm trading this, we have recent lows in ES and NQ that are close enough by where if you wanted to risk 100 points in ES, for example, you could. And if you're right, you probably catch a swing that's 300 or 400 points to the upside. But if you're wrong, you're talking about another potential 400 point flush lower. And like if as a longer term person, right, if I see ES break its current range below 57.75, that to me says step back from accumulating right now, right? This is a good time to have some cash and capital on the side, maybe even sell out of some positions and wait for the correction and then begin to layer in long again. But we'll know quickly because we're kind of teetering on that edge right now. I just don't find the setups compelling again because as a momentum, primary person, where's the momentum right now? If anything, it's tilting lower. And that cuts against my long-term bias. So I'm not going to
There's definitely no momentum. Momentum got murdered over the last couple of weeks. But I guess I would agree that I don't think that the majors are interesting. Like I wouldn't buy the S&P here. But I do think the reason it's trading sloppy, sideways, and a bit ugly is because the underlying components that make up the S&P, some of these instruments are starting to get to interesting levels. So, I mean, whether you want to participate in the Mag 7 or not, I do think there are interesting stocks that have been hammered that to me start to look like interesting buying points. I would agree with you. At the index level, it's shit. It's a 50-50 shot. It's exactly mid-range. And quite frankly, while vol is 19, that's elevated, but given the potential risk of a break of significant support, I don't love how much you're getting paid. If I was getting paid like 22 vol points, then maybe I like the idea of selling some downside puts here. But yeah, I would agree that the major indices, in particular the S&P, doesn't look too interesting. But I wonder if below the surface, either sectors or particular instruments who've been bombed out here, in some cases,
have they been bombed out?
Start to look interesting.
I don't know if they look bombed out.
On a percentage basis, sure. Depends on what you're looking at. What do you mean?
Well, like even in Amazon, yesterday it had that really, really nice rebound over the course of the day. Hammer candle textbook at the downside of a range, right? Looks like a great buying opportunity. We bounce back today. We rally up to the 1 week moving average, and that clocks the high, and we immediately fall back from it. So sure, there was a little bit of a dip, but the rebounds are a little bit of a dip.
It's 20%. It's 20% off highs.
No, I mean yesterday you have that dip and you pull back, and now you rally up a little bit today, and then you have a little bit of a dip off of today's high. But that little dip off of today's high is still so instructive because it just goes to show that there's no staying power right now, and it feels like that's a sign of systemic weakness. that you're looking for signs of these, technical bottoming signals. And the moment you run into some sort of momentum level, the market immediately fails there. And that's not a good look right now. So if it's Amazon, if it's Apple, we'll see what Apple does tomorrow against its 1 month moving average. But Amazon looked pretty crummy today. I know that Meta's been coming back in over the past few weeks, and today's action not quite as terrible as everything else, but it tries to get back above its 1 month moving average and falls down below there again. And that's not the kind of behavior we had been seeing when this thing was ripping to the upside for 20 odd days in a row. So just there's some characteristic behavior changes in the technicals of even some of the individual names that warrant some caution. But I think the bigger picture is, though, if we are going into recession conditions, stock picking is going to be fantastic, right? If you can do sector rotation, you can avoid the noise in the top line indexes and find a place like XLP or XLE that have perhaps been ignored for recent years and tend to do well in the defensive shifts. Or you could just use it as a signal to step up your trading in other places. Like, stocks have been crummy this year. My shots at longs haven't worked out. But finally, bonds worked. Finally, gold worked. Gold's been working. And that's more than enough to offset the disappointment we've seen in a directional move thus far in ES or in Q.
I just can't. I can't. What do you make of vol being at 19? What do you make of
I've been quoting you all day.
At 19?
I've been quoting you all day. I go,
what?
this is the gray zone. If you're between if you're like 17 and a half to 19 and a half, 18, 20, you're in that zone where statistically the odds of breaking up 2 or 3 points are the same as breaking down 2 or 3 points. And when you're sitting near support in ES, do I really just want to jump in here with such negative momentum that's accumulating right now and look to sell put spreads, when in reality we could get a vol spike and a break of the range and all of a sudden it's a double tap? And that sucks. I don't want that. So I just don't I think I'm with you. This is the tricky part for where the VIX is sitting right now in both spot and in the futures market.
It's super tricky because this 4 days in a row of selling, but only getting back to the midpoint with no real vol spike and no real capitulation. Here's what happens. Everybody, there's sort of, I don't want to say here's what happens, but if you don't get a real nasty spike or if you don't get a discounted price, the market is everyone's going to do this thing in 3 days. They're going to go, oh, see, everyone got worked up about growth. Everyone over-rotated, only buy the dip, idiots. And then we're going to go triple top. So my biggest thing is to me, the narrative is so negative, but to me, the price action doesn't match the negative narrative right now. And I of all people, I think we're trading in the clouds. And at some point, we've got to pay the piper here. But it just feels like it's too easy right now. The negative narrative, it's too much. And it's too much without the accompanying signals of a real vol spike, a real flush, any sign of capitulation. It's a 4-day orderly sell-off. And if you don't do enough damage to people and you give them 20% off the Mag 7, I don't know that this thing holds. And I, in the very short term, I'd be looking for opportunities to get exposure on the low end of this range for another run up to the up end or end of the range. I wouldn't trust it, but it just feels like the setup is too easy. It's like a children's book right now.
Give me 5,800 and I will happily pile in with a sizable long position trying to say that the range low is going to hold. But I mean, again, midpoint of the range, VIX where it is, and then the number of stocks trading above their 20-day moving average as of today's close is 45.12 in the S&P 500. You think about the VIX spike at the end of December, that coincided with fewer than 8% of stocks in the S&P 500 trading above their 20-day moving average, which in recent years, that's been a signal that the market has been flushed out and a bottom is nearby. So we're nowhere near the bottom is nearby type of thing. And VIX, we're not near the yearly highs even. So this is kind of a danger spot. You're flipping. Yeah. I feel very much like I'm flipping a coin right now. And that's why short iron condor, let's just say the range holds. Let's just say this 400 range point, 57.75 to 61.75 holds for now. And if we get a top, we trade it like a top. And if it's a continuation, we trade it like a continuation. But this chop, I've been trying to trade out of the chop thinking we're going to get some upside movement. And it's fallen flat for whatever reason, deep sea tariffs, what have you.
It's just, I don't know. My personal opinion is it's too expensive. So finding a catalyst to break us on the upside, it's going to be hard. But the interesting thing is, if you wanted one, you're getting lower yields. And theoretically, I mean, this is all the stuff that should have helped to be a catalyst to move us towards the upside, right? Lower yields, I don't know, growth expectations coming in a bit, but they're still relatively elevated, more cuts into the future. I mean, these were all the things that bulls were sort of, again, it always depends on how you get these things, and you made that point eloquently earlier. But if you told me you were going to get a bunch of cuts and you were going to get lower yields with that, I would say, okay, that's probably constructive. The only problem is that only happens if people are scared shitless of growth. You mentioned bonds before, bonds at 117 or nearly 118. Just a rally from the gods. And this was a hard one to hold on to. But from 110 up to 118, I suppose the question after this move is, what do you do now? What do you do now with bonds, in your opinion?
4 cuts seems rich. 4 cuts seems rich. That seems like it's a little rich. We only get 4 cuts if you're going to get a recession, right? And
why do you say that?
Because if you're getting the policy,
I get what you're saying. You meaning the 4 cuts only plays out in reality if we're going to go through a growth slowdown. That's what you're saying.
Right. And I point to that because I think about the market reaction mechanism to CPI data. The last CPI report was way warmer than anticipated, right? 0.5% on the headline versus 0.3. Now, when you look beneath the surface, it's like transportation services, car insurance, and, okay, a lot of one-off rebasing stuff still. Do you really take it that seriously? You could look past it. The market did. We recovered almost immediately. But then the PMIs come out. I mean, to his credit, Ilya has been bandying on about the PMIs, like, oh, the PMI is the most important report this week. And sure enough, like, they punched above their weight. They had a much bigger staying power than the actual inflation report did. So, if you look at bonds, then the bond move is predicated on the U.S. economy gliding into recession. And you have to think that we are going there and that the Fed is going to deliver on that. And I am out of my short put spread in ZB after yesterday's move up. So I missed the last 20 ticks or so, but it was 110, 108 when we were back looking at like a 50 IVR and the market was thinking about 1 cut through next year. So we moved away from that extreme now. Do I really feel like that we're going to have 4? I'd rather be in gold at the end of the day. I think about our previous conversations, Victor. Again, what's the best performing asset class if you're heading into a recession? If you look back to like 1985 or so, the 2 things that perform best, long end of the curve and gold, plain and simple. I just prefer to be in gold given everything that's happening in the world and the seemingly balkanization of trade and the U.S., I guess, managing its own decline out of a hegemonic world order into a more multipolar world. Gold seems like the better place to be than treasuries if we're going to be defensive and play a recession fear.
I don't disagree with that for many different reasons. At the beginning of this week, I was hoping we would get a 5% down day, which would be about 150 point down day in gold. We didn't get it. We got exactly half. We got a 75 point down day the other day. Which, that's what happens. You never get what you ask for. You get something short of it, and then you get put to the test. What are you going to do? Knowing that you would rather be in gold, but knowing that we are also sitting at highs, how does Chris Vecchio think about positioning into that? Do you go directly into gold? Do you do something risk-defying like upside call spreads just in case you get a breakdown? Do you look at the gold miners as I've been doing, the unloved gold miners, which got a little bit of love today? To me, it makes no sense what's happening in the miners. Newmont got absolutely blasted over the last couple of days on positive earnings, but I think a lot of that positivity had already been priced into the market. So you got it at nearly 42 yesterday, 43.5 today. That's my proxy for playing into gold because I think there's some discount there. how do you express your opinion at gold 3,000, knowing that you want additional long deltas, or you still have a bullish position or bullish outlook, I should say?
So my whole thing, since we started to break out through 27.25 has been rolling up gold call spreads. Recently, there's been a decline in volatility here, right? And that's pretty important because gold's best days are when vol is expanding. So an early indication last week that maybe we were coming into a choppy range and carving out a near-term top would be the fact that gold vol was coming off the board. That said, while gold vol has deteriorated, prices really haven't moved. We're still at the midpoint of the range that we've been in since February 10th from the open there. We closed that day at 29.34. We're currently at 29.33. We've ebbed and flowed a little bit on either end. It's about a $70 range. The bigger picture here is that gold still looks like it wants to move above 3K. I have a measured move at 39.20 cents in the GCJ5 contract. And if we take the measurement in what looks to be a bull flag, that's going to carry you well past that longer-term Fibonacci extension. And so consistent with that, so long as we are holding up and as long as we're maintaining those closes north of that 1 month moving average, then I am comfortable with staying long the calls or call spreads, depending upon what each person feels is best for them. But the way I've been playing it on the Tasty Live follow page has been just out of the money call spreads and rolling up as we reach the long strike. And that is something that Jamal just took off the table 2 days ago. Kudos on him because it was north of 29.50. For me, I would like to get back to 29.50, and then I'll roll forward with a long 3K short 30.50 call spread. Just not going to step off. And again, I'm very smooth brain like this, Victor. I know that my momentum trading is not going to work at some point in time. I've accepted it as a way of life. This could be the trade that doesn't work, but if you catch 2 out of 3 and the last one structured in a manner where the max loss eats into the half the gains of the previous winner, you walk away from the table net up. So that's just how the strategies work for me for the past year in gold. Trade long, out of the money calls, roll up until it breaks. And when it breaks, step back for a few weeks. And if it starts to break out again, start doing it again. So that's working now, and it's, there's no reason for me to think it's going to stop working.
I think I did that, I think it was either last year or 2022, but I mix up the years. And when you're in it, it's great. But then when you're not in it and gold is at an all-time high, it's really hard to pull that trigger. So then, and that's kind of where I'm at. I was in gold for a very long time, and now I'm not in paper gold. And for the last almost 3 months now, it's just gone one direction. It hasn't given anybody who's not in the trade a real opportunity to get in it at an attractive price. So that's why I've sort of been forced to go about it through other proxies, Newmont and other things. But as an aside, I don't know how much you've looked into this. We didn't plan on talking about this, but I'm gonna throw it out. I won't be able to volley with you much because I haven't dug into it yet. But I'm curious, since we just talked about treasuries and we talked about gold, do you have an opinion on the budget that the House just passed? Did you look into that at all? I'm guessing you've had enough. I mean, you stay steeped in this stuff. Did you have an opinion?
I feel. Are you yanking on my chain? I feel like you know the answer to this question.
Well, I'm trying to give you an out just in case you hadn't had the opportunity to dig in. So I'm guessing you have, but I wanted to ask it in a way that didn't expect it just in case you hadn't. That's what I was doing.
It's fair. They only voted on the bill yesterday, so what could I have possibly been doing since yesterday to read a House spending bill? Yeah. I mean, look, I remember, I'm so old that I remember when Paul Ryan proposed cutting $125 to $150 billion from Medicaid to fund tax cuts, pulled at like minus 30% in 2017. And obviously the plan went nowhere because it was seen as politically toxic and you couldn't do something like that heading into the midterms. Which begs the question, right now, the program that they've set forth, which let's just do this with a heavy grain of salt. I don't like this. This is not going to be the final bill.
It won't.
So whatever numbers that we see here and discuss today, just know this is a framework because the Senate's going to make their revisions and amendments and it's going to go back to the House and it's going to go back to right. And so But right now, it's 800. The big line item for me is $800 billion cut from Medicaid, $200 billion cut from SNAP to offset $1 trillion in tax cuts.
To dot the I's and cross T's, I think it's $880 billion cut from Medicaid and $230 billion cut from SNAP, which is food stamps. Yeah, go ahead.
Sorry. So it's 1.1 trillion worth of cuts, not 1 trillion worth of cuts. 1.1 trillion worth of cuts to these social safety net programs to offset tax cuts. Which, granted, if the 125 to 150 billion were seen as politically poisonous, I would think that this plan may not be received that well by the American public either right now, given the zeitgeist that we're going through, where we're, trying to get transparent and make government work for the people. So whether or not that ultimately becomes the law of the land is another story. That's perhaps why the market hasn't reacted to this all that much. Does it get scaled back? Maybe. I think ultimately the goal was just to get the ball moving forward, because I know, like for my congressman, Mike Lawler, for example, he has been making it very clear in every medium possible that the singular focus is making sure that the the SALT tax cap is bumped up or repealed again, so that New Yorkers and other high tax state residents can write off more of their taxes effectively, which I would be a fan of. I live in New York. But that didn't get included in the most recent program. So clearly there is some understanding with House leadership and the members who towed the line. Only one, Thomas Massey, didn't vote yes with the entire GOP caucus. There has to be some understanding that this is just a starting point of a framework to get it to the Senate, and they're going to make their revisions. Murkowski, the senator from Alaska today, noted that the Medicaid cuts proposed would be ruinous for Alaskans writ large. And so she is, again, can you afford to lose 2, 3, 4 senators now? No, you can't. So it's not going anywhere. But if this is the plan that goes through, Victor Jones, this is not these aren't the Doge cuts, right? Then the Doge cuts that have happened so far, I don't know if you've been following this story, but the 5 biggest ones that they had announced on their website have since been scaled back because the documentation that they posted was inaccurate. The numbers that they said they saved, that were claimed to have saved, were inaccurate. And so the Doge cuts, as Polymarket's tracking them, maybe it's $55 billion so far, but in the face of a new budget that's going to add $300 billion plus to the deficit this year and $250 billion plus the year after that, and something to the same tune in the following fiscal year.
It's about $2.5 trillion over
a
few years.
$50 billion in cuts for these programs that were scaled out over 10 years versus $2.5 trillion, $3 trillion of new debt. Peanuts. Right. So it's great. It's quote, great theater. It's made for some really interesting tweets and conversations and, big balls, nicknames, I guess. But beyond that, in terms of actual fiscal policy, looks like kind of like a Reagan, George Bush bending plan. Cut taxes, cut entitlements. It's Paul Ryan's dream, actually, that to a degree that he couldn't get passed through, and he ultimately stepped down as Speaker of the House because of it. So what a change in just 6 years. 7 years? Yeah. Gosh, 2017? That was 8 years ago, Victor.
Paul Ryan was an idiot. We're better for him stepping down. 2.8 trillion added to the deficit over basically 10 years until 2034. And I agree with you. I don't think this is the final. And I also think I don't know, I might be wrong on this, but I think what tends to happen is the administration will sit back and they'll see what's politically popular or unpopular. Trump will only attach himself in most cases to things that are fairly politically popular. Not always, but most of the time. In this particular case, I wonder if he's not necessarily going to come out strongly in favor of a budget or in favor of Medicaid cuts. I think he'll be totally quiet on this. I might be completely wrong and have pie on my face. And he likes to come in at the 11th hour and look like a savior. It's what happened with TikTok. It happens with things that are politically unpopular, even if it's a Republican thing. So to come in and say, we can't cut Medicaid or we can't do this. I wouldn't put that out of the cards for something like that to happen. But even if it doesn't, I would agree with you. This would be pretty unpopular to cut to cut nearly $1 trillion from Medicaid and $230 billion from food stamps, and to fuel $4.5 trillion of tax cuts, and still add $2.5 trillion to the deficit over the next 9 or 10 years. I don't. What's
great about that tax plan?
That almost really
our taxes would go up.
Yeah. Maybe. I don't think so.
I have a tax attorney mother, Victor. I asked all the questions last night. My taxes are going to go up.
Yours might. Here's my point, that it would satisfy nobody, because your fiscal conservatives, it's not going to satisfy them. It's not going to satisfy sort of the populi that helped to get Donald Trump elected. It kind of it's like shit across the board, except for sort of an uber wealthy who's going to benefit through some of those tax cuts. So I don't see, and the biggest thing is there wasn't even cuts in defense spending. Nope. So you can cut out of Medicaid, you can cut out of food stamps, but you're going to keep defense spending the same, if not add a few more dollars here and there. It's like this is clearly step one in what will likely be a negotiation. And that's kind of their style. They go way left in order to negotiate it back towards something that they still feel like they won on. But the problem with that is you're going to get a lot of ammo. Political opposition is going to get a lot of ammo because this does not look good on paper. There's almost nobody that's going to be excited about this on paper.
Well, Democrats are excited about this on paper insofar as now when Trump comes in and can claim the victory that you say he's going to claim. Look, they were talking about cutting Medicaid by $880 billion. We negotiated it down to only $400 billion, right? We got to support the American people, but we got to save money, right? Like, well, now you have all these House Republicans who are on record saying, like, we were willing to cut $880 billion. We voted yes in favor of it. Like, so you just sailed. Man, have you been watching some of these town halls? People are caring right now, Victor, about what's going on in the federal government. The town halls have been wild, to say the least. They remind me of the Obamacare town halls in 2010, 2011. Okay. So look, there's going to be political pushback, but if there's a window to do all this stuff, it's now. Midterms are next year. That's what matters most, right? All these House Republicans, they have a political future ahead of them, so they hope. So there will be moves, and they will vote according to that. Because Trump is, he will be a lame duck if there is not a House majority next year. The Republicans will keep the Senate. But if there's no House majority next year, you're going to get gridlock again, and then nothing legislatively happens in D.C. for another 2 years.
Mm-hmm. Well, if you had to bet right now, do you think Republicans hold post midterms?
No, if only because of the historical swing. And I think, in fairness, the 2022 midterms were a bit of a surprise, right? Well, 2022 midterms were a surprise because we expected a bigger blowback against Democrats. And it really didn't materialize to the degree that one would think in line with historical standards. Typically,
because they used the Roe versus Wade overturning. Pelosi used it really, really effectively to mobilize.
Yes. So then, what's the issue?
2022 midterms.
So then, what's the wedge issue that Republicans can deploy to help brunt the historical swing that typically goes against the incumbent's party in midterms?
I just think sitting down. I just think sitting down and laying dead. I think Democrats just don't understand. I think the strategy is to do nothing, to offer nothing, and to hope that this administration runs into enough speed bumps that they can put in people's feeds and put in people's face that rabble-rouse them enough to be enthusiastic again. Because their biggest problem was the Democratic vote. They just didn't show up. Like in Chicago, I think Biden got 944,000, dropped to 700,000 votes for Biden. And it's like, I think they think their biggest problem was a lack of enthusiasm. And if we can just rabble rouse these guys up, we can get them back out to the polls. And I think that's a losing strategy. I don't think it's going to work.
Yeah, I mean, from the polling data that I've seen in the first month of the Trump administration, most people, including people who had Democratic congressmen, were like, work with the Trump admin. Something like 56 to 44 in that neighborhood. Like, we want
People
you
are
to
tired of that shit. Yeah.
It's switched now. It's now like 35-65. It's now like, no, don't work with the Trump administration because of everything that's happened in the course of February.
Dude, again, people
I hear you.
People that believe these polls don't understand human nature. Like the idea, I never get how smart people can be just hoodwinked by these fucking polls. If people believe something 1 month, the entirety of a nation does not flip on a dime without some big catalyst event. It's so these
you don't think
polls
there's been
get
any
used.
catalysts in February? The constant stream of Elon Musk in the White House with a chainsaw talking about how he's going to fire all these people. And you don't think this has an effect on the American, even though it's showing up in PMI data now?
I think wine moms, I think it has a big deal on wine moms that spend too much time scrolling on their phones. I think it probably does.
That's like me. I'm basically a me.
I did not see that coming.
It's your buddy Chris. You know me.
I did not see that. I think I got that term from you the other day. I can't remember what you said, but I was like, I like that phrase. That's me. All right, man. Let's move on. I'm pretty sure we've got 3 more minutes left, and I don't know. Maybe the ramblings there probably lost half the audience. So, in a nutshell, we both think this is step one of a negotiation. I think kudos to Thomas Massey, who always seems to vote on the right side of history. So where do you think they end up? Do you think do you think wherever they negotiate, do you think they might pull a lever down, pull a lever up, they might pull something from defense, add something back to Medicaid? Do you think wherever this budget ends up, it's somewhere in the ballpark of $2.8 trillion to the deficit over the next 10 years, and that's ultimately what we need to care about as people who care about the curve? I think that number is probably pretty fixed. I don't think that's going very far. I think it'll go down, if anything.
Yeah, I think you're probably right. Yeah. I mean, look, we're kind of painted in a box right now. Realistically, the Fed is with Powell at the helm. Maybe if Trump appoints someone else in the future, you get a more proactive Fed. But that's then totally different than what the market's been used to for decades. So
proactive Fed, as in what? More hawkish or more dovish? What do you mean by more proactive?
So right now, the Fed is concerned about tariffs. If they were a proactive group, they would start raising rates now to tamp down inflation pressures in advance of the tariffs coming, right? But they're not a proactive group. They're a reactionary group. They don't want to tighten up the economy now in the event that the tariffs never materialize, or the impact of the tariffs when they do materialize. What if they're offset? What if they're not long lasting, right? Do they really require that type of change when the tariffs go into effect? How quickly will the economy adapt and evolve? Right? Will new industries at home spring up and offset the decline in trade abroad? And, maybe that's enough to power real growth higher. We get a little bit more inflation, but hey, GDP is that much faster. Does that require a rate hike or not? So the Fed is they can't do anything right now. But a future Fed chair may say, hey, tariffs are coming. We think this is inflationary. We're going to raise rates now so that we discourage people from pulling forward all that aggregate demand, right? Which would then become inflationary in a self-fulfilling kind of prophecy. If I think prices are going to be higher because of tariffs 3 months from now, I'm going to buy the things now today. And a lot of other people may think that too. So the Fed says, let's just get ahead of this. Let's just ratchet up those rates. Yeah, a proactive Fed would have already raised rates at this point in time, given the concerns they've talked about. But they are reactive.
Do you think they would have been wrong to do so? I'm just
Yes.
I agree. Because the 5-year, forward inflation expectations, while you did see a short-term spike in January, it seems they've cooled off, and we're now at the exact same point we were before all this started, and ultimately at the low end of the range from where we've been for the last few years. So I think for all of our tariffs inflationary, and there is a price adjustment, let's not kid ourselves, but the inflation expectations, while they did drift, are still anchored around 2.2.
Yeah, I mean, I think that's ultimately the tell. So the Fed, until the credit market starts to crack, which it has not by any stretch of the imagination, but until the credit market starts to crack around any of these issues, just as we said coming out of SVB and Signature Bank failing, the Fed is not going to move off of course. It's not going to front run an issue that may not materialize. It will watch it. It will stand by. If it has to cut rates or do something in an emergency fashion, it will. But so the Fed is boxed in, and now we have fiscal policy that's, it's a lot of dog and pony show, but the reality is deficits are going to grow. I guess the question is whether or not the tariffs go into place. And we're still trying to figure out what the tariffs are actually being used for, if it's to replace income taxes or if it's to just rebalance trade or if it's really to just make us an autarky. Who knows? The Calvin ball aspect of it continues. But again, now they're kicked out another month. So the sword of Damocles, we still will not cut that knot. It will swing over us in perpetuity, it feels like.
And I think when the 30-day thing happened, the 30-day extension happened, you and I talked about this, and like the odds that we were going to resolve it in 30 days was nil. Like the odds that it was going to be extended was nearly 100%, I think, in both of our minds. So let me ask you this. I can't let you get out of here without talking Bitcoin, which is now trading 84,000. Coinbase, a lot of these things that trade alongside or in sympathy with Bitcoin have taken significant haircuts off of their highs as well. I know you're a long-term holder, so let's put that aside. Let's just talk from a trading perspective. Do you have enough of a discount to take a short-term long stab at Bitcoin here in the 80s?
No, I don't. SBF is tweeting again. So that's probably bad. And the fact that he tweets and the market breaks the range the other night. Bitcoin is really unique. Yeah, it's a bad omen. There are the signs like, when I wave a sword around on camera, when the market hits a new all-time high, like as a bull, you go take profits. Like SBF tweeting, that's a time that you think, okay, well, I think about this philosophically. If the Trump admin is out here, SBF is clearly fishing for a pardon. They pardon Ross Ulbricht. Like, who's to say that Trump just turns around and says, like, yeah, we want to, free SBF because it was done under the woke Biden DOJ or whatever rationale he rolls out there. You're telling the world, we're slowly informing the world that U.S. regulators actually don't give two hoots about what happens in the crypto space. If bad actors are found, they'll get a slap on the wrist. They'll get what was taken from them. They'll have to give it back. They may spend some time in jail, but ultimately they'll be forgiven and be allowed to go back into society once more. He may be banned from securities trading, but again, do you trust an industry that's going to be rife with these kind of people? And I think the sentiment right now is, really captured well by this tweet the other day. Years ago, the villains in crypto were Do Kwon and SPF talking about game theory. And now we're getting you get these leaked messages from Discord from like the guy who's behind Argentina's Libra project, where he's like, to be honest, this is just like a max extract kind of effort, right? Like they're not even hiding the villainy anymore. And so it feels kind of exhaustive right now in the short run, where, sentiment wise, the people who are supposed to be the champions of this new order of finance in Trump and in Malay, what did they do? They launched these meme coins that have been rugged effectively, trading 90%, 85% off the highs. If you look at Libra, if you look at the Melania coin, if you look at the Trump coin, and they may not be putting in significant regulations yet. We're waiting for David Sachs to bring forward, his own recommendations. We obviously know SAB 122 went through. But what is driving the sentiment higher right now? Like, what's the impulse? Fundamentally, and I made this point on Overtime today, you can't really do traditional fundamental analysis because there's no balance sheet, right? There's no macro data. So you look at various metrics like on-chain things or the number of counts or transactions on-chain or the number of liquidity or, various tokenomics, what have you. But there's no like generally accepted accounting principles for how to do fundamental analysis in Bitcoin. So it's a much more technically driven market because that is the single language that all traders speak. We all can look at charts and all can look at the lines on the charts. And to that end, technically, Bitcoin looks like trash right now. You know, you're talking about a break of this range, 105K down to 90. That looks like it's a bit of a top. The measured move has a, falling back towards 70 to 75, depending upon your point, which does bring you pretty close to some of the swing highs that we saw last year before we began our multi-month flagging pattern. And down there at 70 or 75K, having completed a measured move, having returned to a former swing high, knowing that this is a very technically driven market and has been for a long time, I am very interested at looking long deltas down there. But here, in a growth off kind of world, Vic, lower yields, when Lambo, right? You, me, and Andy Constant talked about this a few years ago. How do you get from T-bills out to Lamborghinis? How do you get to the Bitcoin? The lower interest rates push people out along the risk spectrum. So again, lower rates and Bitcoin getting pummeled, that's no bueno.
So your new level, I'm sorry you said it, but I missed the exact.
Give me somewhere between
in the
70s. Give me somewhere between 70 and 75K.
Yeah, I think that makes a lot of sense too, because you basically everyone that's been accumulating since November is now underwater, and as long as we stay in a range between 90 and something like 70, you put them to a test. And the longer we stay in a new lower range, the more likelihood I think it is that we see a price between 70 and 75.
No, but it's so great, right? For people who've been involved in this for a long time, you can see the dichotomy in people's comments. Like personally, it's like, well, just another 20% drawdown in the world of cryptocurrency. But you can see the people who've just bought in, and you can see on Twitter like, oh, my so-and-so's freaking out. He has like a 20% drawdown on his crypto that he purchased at 103. It's like, oh, this really is your first rodeo. Like, welcome. Like, yeah.
Oh, man. It's always fun to chop it up with you. Thanks for taking that venture into the budget conversation. I had really two fascinating conversations this week. Yesterday's was with Ilya on the new commission to basically go over the central bank and their dual mandate, which I would love to talk with you about hopefully sometime in the future. And then getting your opinion on the budget. I really enjoyed the last 2 days. Chris Vecchio, if people want more from you, tell them where they can go.
Twitter at CVecchioFX, here on Tasty Live Monday through Friday, Futures Power Hour, 1 p.m. Eastern, overtime, Monday through Thursday, 4 p.m. Eastern. Let Me Explain, Tuesday mornings, 9:40 a.m. Eastern. And of course, here with you, Vic, on Wednesdays, the price, what's the word? Truth. That's at 6 p.m. Eastern, 5 Central.
My man. Thank you very much, Chris Vecchio. And thanks all of you for spending a little bit more than an hour with us. Hit the like button on your way out the door. Subscribe to the channel if you haven't already. Make sure you follow Chris Vecchio on his socials. And if you want to follow me on Twitter, you can do so at Victor Jones, the O and Jones, the 0. I'll see you back here tomorrow. Same time, same place, same great network, only on Tasty Live. Peace.